Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
We're not full gloom, I would say, but yeah, we're not terribly optimistic that we will get this true soft landing. We're really less optimistic that this will end well, and that inflation will come back sustainably to 2% without some bigger downturn. If we are getting inflation sustainably back to 2%, that has to happen with some kind of, contraction, something that we would call a recession.
Veronica Clark there of Citi, some kind of contraction that we would call, a recession. Marko Kolanovic over at JP Morgan agreeing with her, talking about the soft landing delusion of the hopes and dreams of the equity market bulls. Those people, of course, have missed out on a rally so far here today. UPS is negative in the pre-market. It's one to watch this morning. We're down by about 6.7%. They've cut their outlook for revenue. Plenty more earnings through the week, including the Walt Disney Company coming after the close tomorrow. Elsewhere in the equity market, equity futures at the moment negative by 0.5% on the S&P 500. Bit of risk aversion out there this morning. It's captured by the bond market. Yields are lower here by 9 basis points. Your 10-year, Tom, 3.99, just short of 4%.
Moments ago, Eli Lilly out with a little bit of joy to push against deflationary tone that's out there. They're looking at some revenue lifts as well. I guess the stock is getting some kind of lift here. We're just getting this out moments ago, but there's something pushing against it. I mean, it's up nicely. It's up 8%. I don't know where that's from. It's got to be a misprint, but. Nevertheless,
would you like me to go through the numbers?
I don't. The numbers are what they are.
We're not all mind readers. I'll go through the numbers. You mentioned the stock now. So here's revenue. This is what they see, Tom, for the outlook: 33.4 billion to 33.9. That's the range. They had seen 31.2 to 31.7. So that's a better range, Tom. For EPS, 970 to 990. They had seen 865 to 885. So they've raised guidance over at Lilly, Tom. The stock is higher by 8.5%, beating a race.
And maybe beyond COVID. I mean, maybe that's really what this is about, is American pharmaceuticals and all the rest getting beyond the pandemic. Not getting beyond the banking challenges of Europe, as our Patrick Barnard, he's in Frankfurt this morning here, on the Italian banks, but there was some knock-on effect. Why are the German banks going down as well? I mean, I get it. UniCredit and the rest down. Okay, challenges at the Italian banks. Why are the German banks affected?
Well, for two reasons. One of them is the German banks are highly skewed to higher interest rates because there's a lot of corporate and retail business in there. And I'm very surprised that the Italians have been the first one to introduce this idea, because we have a very capital market unfriendly government in Germany and a very anti-banking government in Germany since a couple of years now. And they have been pouched this idea a couple of times to put a tax or higher taxes on banks, and that's a very voter-friendly topic, so to speak, in Germany. So I guess if now Italy does the first step, they are very happy about this and be the next one to follow suit.
Are we going to see taxes in Zurich for the last bank standing? I mean, you can carry it right over to Switzerland?
That's a fantastic question. I mean, you have a big debate in Switzerland about all the taxpayer money that is going into the merger, even though it's just guarantees and it's not hard cash paid yet. But I guess again, there the voter would be very sympathetic to say okay, we helped you out, guys, for the screw up again after 15 years of the financial crisis. So now we want our money back. I'm not saying it's fair, but if you are a politician, this is a drum you can play very long and very loud, and you will get a lot of applause for it.
Patrick, we've also seen all of the U.S. earnings of U.S. banks, and they highlight the market share gains that they have gotten from European banks, that finally we're seeing the light at the end of the tunnel of low-rate policies, but oh, wait. And then you're seeing some of these other policies come into the fore. How much do you hear about people opting not to work at some of these banks or opting not to bank with some of these banks because they are concerned about regulatory overhang that goes beyond what it is in the U.S.?
Well, I can't stop smiling when you say all that, because it falls into the whole category. Why this tax is now also being introduced is and why people are not buying banks and don't like really to work for banks is there is no shred of public sympathy ever at all for European banks. on the contrary, there's this feeling for 15 years now that they have a debt from all the help that they received during the financial crisis, where they screwed up big time, and that they have to repay this debt to the public if they ever can, if the public is ever satisfied with, like, now you have paid off enough of your guilt that we helped you out so big, and that you did not go bankrupt, and that nobody went to jail for all the mess up that we have seen in 2008, 2009. And I have a feeling this will never change. And that's why it's so funny when people say, like, the sector is cheap and it has good earnings and shareholder output. All true. Of course, it looks that cheap on paper, but there is no sympathy for the sector. So when you go in as an investor or as an employee, you have to be aware that whenever there's a chance from the public to take out money out of the sector, they will for sure do it, and they will not care about any shareholder return or stock market or whatever.
From a U.S. point of view, I saw the proposal this morning, and I thought, really, is this going to go into effect, or is this just basically playing lip service to generate some popular support? You're making it sound like you believe it much more, that it will go into effect, and that it might even serve as a template for other countries. Is that what you're saying?
Yeah, absolutely. I believe they will do it. I mean, like, the question is, like, not if they want to do it. The question is just, like, how big they want to do it. The banks can't fight it in the public because they will lose this argument for sure. Nobody will be on their side. So the only thing that they can do is, like, do their usual lobby thing, which they have also tried with, like, regulation and stuff. And they didn't prevent regulation in Europe. They only toned it down to a degree where they felt like, okay, this is doable, this is manageable for us, and we still can keep the shareholders sort of happy. And I'm pretty sure this will happen here again. They will work behind closed doors to make sure that this tax is not going to be out of the box and totally ruining any earnings report going forward from here. But I mean, like, now it's out in the open. And as an Italian politician, you can't, like, backpedal and say now, like, oh, we're not doing it at all. The banks are fine, and we just, like, let them do their thing. It's not going to happen. Not in my book.
We're making fun this morning, Jan Patrick. Out in Los Angeles, Disney is setting up a task force. I don't know if task force translates in Zurich or Frankfurt, but are they going to set up task forces at this bank? I mean,
yeah, for sure.
To me, it sounds like a perfect time to set up the Pharaoh task force of the Italian banks. John can fly over and consult for $10,000 an hour.
Yeah, absolutely. But yeah, there you say it, $10,000 an hour. So it's golden time for all the consultants, for the lobbyists. I mean, like, they will, like, in Zurich, they're popping champagne already. And not in Zurich, in Brussels, they're popping champagne already because, like, yeah, this is going to be a 12-month battle for this tax to go, or 24-month battle, whatever, until this tax is ready, and they will, like, earn tons of money from it. And in the end, I don't know what they do, but, like, the banking sector in Europe, it's so screwed up. I mean, like, I don't know what else to say.
He's almost like an American.
Absolutely exasperated.
No, but I mean, like, what can you say? Like, the business model is very difficult. There's no sympathy in the public eye. There's no positive regulation. The interest rate story, I mean, it was nice, but it has peaked as well. They're always skewed when the economy goes down. I mean, in Europe, it's a different story in the US, I get that, but in Europe, it's horrible.
Oh, it's completely different here.
If you go for lunch with Lisa, Jan Patrick, that would be a hoot. Jan Patrick Barnett.
I'm having so much fun listening to you.
Just wonderful. Exasperated with what's been going on. Lisa, damned if rates are low and damned if they're high, apparently, over on the continent.
I love how Jan Patrick said, the interest rate story, it was nice, but now it's probably peaked, so here we are. I mean, the frustration here is, even when they actually are able to earn income, then the public sentiment comes into fore. They haven't really washed out the sentiment deterioration that they felt during the peak of the financial crisis, and now they're facing off with a cost of living crisis. This is a different story, and it highlights some of the differentials between Europe right now and the U.S.
If Bill Gross was sitting here, he would point out, as John Taylor of Stanford has pointed out, and he basically invented the phrase, there was a great moderation. There was a entrenched trend of lower yields, some would suggest lower volatility along the way. It's over. Pandemic, whatever, great financial crisis. But the great moderation, is it over? And what's it mean for all of banking, including, the stasis of European banks?
Well, clearly, anyone who is bullish the European banks has got a bit of a reality check this morning. Government officials have got other ideas. And to Jan Patrick's point, look, it remains to be seen what shape or size this actually goes through in Italy. Could be changed in Parliament, could be challenged in the courts. We haven't got a clue, but there's a feeling it just changes the mood music around the European banks. Do the rate hikes matter?
Yeah, BNP Paribas, 6.8% yield, dividend yield.
Well, the French love a
that's
tax, don't
difference.
they, Tom? You know.
I mean, it's amazing. It is a foreign enterprise compared to what we see in the U.S. That was classic. It was really.
Thank you. You weren't interested in that story this morning.
I'm not interested in the Italian story. I've been listening to it for 30 years, but the knock-on effect of the other banks, I think, is a big deal.
You're interested now.
Deutsche Bank.
Okay. Binky Chada at Deutsche Bank is going to be joining us shortly. Equity futures on the S&P 500, negative here by 0.55%. Yields are lower by 9 basis points, a break of 4%, 399.99, and UPS struggling, cutting the outlook for revenue over at UPS. That stock is down in the pre-market. From New York City, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
I think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Broadly speaking, the economy has been extraordinarily resilient to very high interest rates. It just feels like this market needs to stop, pause, have a little moment of digestion, and catch its breath.
It seems like we're getting to the end of the Fed tightening cycle.
If we are getting inflation sustainably back to 2%, that has to happen with some kind of contractions.
There are signs that certain parts of the economy are reaccelerating.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market this Tuesday morning, negative by 0.55%. You know the runway, the calendar through the rest of this week. CPI data, the main event on Thursday. Looking abroad, the data out of China overnight really disappointing once again, both on exports and imports. TK, weak imports, weak exports out of China.
And this evening we get to the CPI, PPI statistics for China as well, and they signal disinflation, if not outright price decline on a year-over-year basis for the CPI and PPI. It's a deflationary tendency across all of the Bloomberg Launchpad this morning. And John, I'm going to go to the 10-year real yield rapidly over, 3 days, 1.80%. down to a disinflationary 1.59%.
The twin surprise of 2023 so far. China not as good as people thought it would be. The US not as bad as people thought it would be, Lisa.
And are those stories related? Not just because, there is an issue with the fact that their trade is declining, but the fact that Europe has been worse than expected recently. And that's the other side. And Europe is more tied economically to China than the US is at this point on a relative basis, simply because the U.S. has been reducing its dependence on China. So I wonder how much that might be the linchpin, the sort of long economic COVID of China, the linchpin to understanding some of the surprises this year.
Bank of America wrote about this recently, just the breakdown of so-called synchronized growth. There's nothing synchronized about this worldwide at the moment. China is slowing down more than people thought it would. The U.S. has been better than people thought it would be. We've got the potential of more hikes from the Federal Reserve when people were thinking maybe we'd get cuts later this year. Same with the ECB. And Tom, you go one step further. EM is cutting. Chile, Brazil, and others might follow as well. It's a really interesting setup. Divergence regionally just coming to the surface.
I think that's what Michael Spence would say, the Nobel laureate. There's no growth convergence going on right now. It is, as you correctly state, divergence. All these different narratives, Lisa mentioned this last week a number of times, these different narratives out there, and what do they add up to? They add up to central banks on an ex-post basis will have to react to it. How far behind Brazil are we?
True.
I mean, it's that simple.
Is it 6 months, 9 months?
They do okay there?
That was wonderful.
I was going to read it all morning.
A plus, nice. Well done. Let me get to the price action. Equity futures on the S&P down by about 0.6% on the S&P 500. We're negative here. Yields are -2. We're down by about 8 basis points. Call it 9. Treasury's doing okay. Going into a ton of supply. Lisa's going to walk you through that. 3-year today, 10-year tomorrow, 30-year on Thursday, Lisa. In the FX market, a euro 109.52. Bit of dollar strength out there as well.
Fed speak today. We do get two Fed speakers. 8:15 a.m. we get Philadelphia Fed President Patrick Harker. At 8:30 we get Richmond Fed President Tom Barkin. I feel like they're being de-emphasized, to be honest. It's sort of like people shrug them off. They're going to try to guide one way or another, but there is no forward guidance. They're looking at the data. You need to come up with a long-term inflation projection. That said, we're still paying attention. 1 p.m., this is what I'm watching most closely. The U.S. is selling $42 billion of 3-year notes. This comes before tomorrow's $38 billion of 10-year notes that are going to be sold, auctioned off at 1 p.m. tomorrow. And then on Thursday, $23 billion, I believe, of 30-year notes will be sold. How many people step up to buy them at a time where the Treasury market has ballooned over the past 20 years? Just to give you a sense, it has tripled since 2009 to $25 trillion. So if you do have this increase in debt, who is going to buy it? If people do not step up as much, does that cause a complete risk-off feel? Earnings also today. Lyft, Rivian, AMC, Bumble, Duolingo, iRobot, looking for consolidation of power among the largest, seeing if there is any market share cannibalization from the likes of Lyft, which has underperformed, and Rivian, which is up a mere 32% versus Tesla's 100 gazillion%.
Amazing. The doubling of Tesla, just absolutely remarkable. Some C-suite changes there too. We'll talk about that a little bit later. We're just around a table here in New York. Binky Chadha, Chief Global Strategist and Head of Asset Allocation over at Deutsche Bank. Morning, Binky.
Good morning, John.
I love a title in Southside Research, The Wobble. Can we talk about the wobble? What is the wobble in this equity market? What is that?
The wobble is that, we are basically overdue for a 3 to 5% pullback. It would be normal. Believe it or not, we are now running in, 95th percentile plus in terms of the duration, even though it seems rather short since March, since we had a 3 to 5% pullback. As I said, that's pretty normal. 3 to 5% pullbacks happen every 2 to 3 months, so it's getting a bit extended, number one. Number two, as you know, the rise in positioning this time around has been, pretty vertical, especially on the discretionary investor side. And so it's an additional reason, really, for looking for, when that process is over. So I'm not being normative about this as to what should happen, but if and when that does happen, we'll tell you that part sort of played out.
What is the charta process to buy on the dip? I'm fascinated. You're sitting there like Ace Greenberg years ago at Bear Stearns. You got buy tickets over here, sell tickets over here. What's the charta process to buy on the dip?
To buy on the dip, I mean, you have to have a view on what's the catalyst for a correction.
You got to reframe your view 3 years out.
Not 3 years out, but what's driving a pullback. So the kind of pullback I'm talking about is really more sort of a consolidation, and sort of you want to see positioning rise gradually rather than vertically, as it sort of did starting in late May.
Does it make you nervous that everyone on Wall Street, all of your colleagues, are revising upward their expectations for the S&P?
It doesn't make me nervous. It's probably a little bit overdue, is the way I would put it.
You're like, welcome.
We are just reporting, basically, the second quarter of pretty solid sequential growth in earnings. So if this was GDP we were talking about, and you were getting strong growth 2 quarters in a row, I think it would have an impact. The equity market tends to look at things on a year-on-year basis, so that makes the turning points very fuzzy to be able to tell. If you look at headline earnings growth year-on-year, yes, we are still running negative, but a lot of that just simply has to do with oil prices from last year. You take energy earnings out, and it's the first quarter of positive growth year on year after 4 negative quarters. I think it's more important to look at earnings growth on a sequential basis and also on an underlying basis. And really, if you look at underlying earnings, which is taking out energy, taking out the financials loan loss provisions, we've had 2 quarters now of 4% plus growth.
Yeah.
And we only fell 6.5% last year. So actually underlying earnings are at a new high, and the narrative is about a recession.
Well, some people are also pointing to small business optimism, which came out this morning earlier, the highest levels in 8 months, right? So it's sort of edifying your view. How much do yields push against that? We were talking about what's more important for your equity call this week. Is it going to be CPI on Thursday, or is it going to be the Treasury auctions, and how many people step up to buy them?
Yeah, I think yields matter, but it's really been much more over the last 18 months. It's really been much more about the volatility of the message coming out of the rates market rather than the level of rates. So as long as we're talking about, 25 basis points here and there, yeah, this doesn't really impact my view. If we get a big acceleration in inflation and a big, response from the Fed and uncertainty increases, then, it's a bigger concern and a bigger pullback, I would say.
How many of these growth stocks are actually growth stocks anymore? I'm looking at their multiples, and they've got pretty tidy growth multiples on them, but how many are actually delivering growth?
So, I would say, the focus shifts over the course of the cycle. What we've basically seen is, the mega cap growth in tech stocks, their earnings turned around first and very strongly in the first quarter. And it was pretty V-shaped move if you're looking quarter by quarter. And that's now sort of widening out is the way I would put it. So, where's the growth? So first tech caught up with everyone else who hadn't fallen by as much. And the two have really, since late May, mega cap growth in tech and the rest of the S&P 500, they've moved really in tandem. But it does mean that since mega cap growth in tech earnings, since end of May is a very short period, but their earnings do grow faster. So actually on a relative multiple basis, the relative valuation's coming in.
You might be annoyed with me for bringing up a single name, but I think everyone's fascinated by the move with Apple at the moment. Down for 5 straight days into today. Yes, they're trying to snap back this morning and bounce, but ultimately, are they producing the growth? Can we have this the biggest weighting on the S&P 500, the biggest weighting on the NASDAQ 100, traded a multiple of something like 30 times forward earnings when it's not delivering any growth.
Yeah, so, I mean, you know, as you know, I don't comment on individual
I'm just wondering,
stocks.
from a valuation perspective, what the signal is that you take away from that name at the moment and the way it's performed.
Sure, but I think that's part of the process, you know, of sort of the rally that we've seen so far broadening out. It's precisely that question that broadens the rally out because, you know, if we are you know, the market's running with the soft landing narrative, and if the soft landing is going to happen, then you're going to have cyclical growth, and so you should be rotating. And the market has, you know, it's sort of sitting in the middle now. I mean, we're moving in tandem, as I said, after, you know, growth stocks just leading the charge. And at some point, I would expect, you know, the next phase.
Okay, so you got a wobble. The Chata wobble is in place. Does that mean you reset your SPX outlook?
Oh, no.
Did we get to 5,000 this morning on pullback?
I think that, you know, it's important to keep in mind that we haven't fulfilled even the 3% correct, you know, pullback yet. So we were down basically.
We're cratering.
I think, you know, a return of normality after this big repricing that we've had, you know, would be helpful.
Well, just for our listeners and viewers, John, I mean, can we get Chata to go to 5,000 today with the wobble?
Not today, but yes, it is our soft landing target. Yeah.
Binky, thank you for clarifying. Binky Chana there at Deutsche Bank. It's good to see you in a studio. 5K soft landing upside.
I thought that was incredibly soothing. You had a guy with years and years of experience. It's just fabulous.
It's good to see you in person.
Thank you very much.
Welcome to the program. If you're just tuning in, your S&P 500 negative here by 0.6%. Coming up in the next hour, 8 a.m. Eastern Time, Mira Pandit at JP Morgan Asset Management will continue this conversation. Big focus, Tom, on Apple and the way that stock has traded over the last week, down by about 9%, still up year-to-date by close to 40% year-to-date. We should state that. It's had a fantastic run so far in the year, but this is a make-it-or-break-it quarter, right?
It's make it or break it, but we've been here many times before. You know, someday it's not going to work. But I think what the fanboys would say of Apple is get out the calendar. It's early in August, back to school mystery, Christmas mystery, holiday season, boom quarter mystery, and every time this comes around with new products and somebody with a black turtleneck's got to walk out and give us the second coming of Jesus.
I'm not sure they wear the black turtleneck.
Well, whatever. But, you know, the answer is,
on the same page.
Yeah, Mark Gurman says September 22nd or something, you're going to be able to buy the new toys. John Farrell's going to go out and buy the iPhone 19 or whatever it is, and, you know, life goes on.
I'll wait for the 20.
That's the script.
When they stop manipulating the battery.
Yeah.
That's when I'll get
But
you.
the battery is much better. This battery,
is it good?
This is the single biggest surprise on this phone is the battery.
Jonathan, I agree with you. Apple should not be trading at that multiple, and this is off, right?
It's off.
No, it's not.
Good to see you, Binky. Deutsche Bank HR is right over there, Binky. Walk out in front of John's camera. See ya, Binky.
Binky. I actually don't think Binky realised we were still live now. That's totally okay. Rob Waldner's going to join us shortly from Invesco. I'll try and remind him that the camera's still rolling. That was nice. Convinced he didn't have a clue. But it was perfect. It was perfect.
Completely.
Equities on the S&P, negative 0.7%. Are we too relaxed sometimes? People think we're not on air. Maybe.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
Was going to keep Green World Cup. This is a 3.
As the economic picture down.
Is it the okay is getting ready to make this decision?
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Yes or no, did Donald Trump lose the 2020 election?
Whoever puts their hand on the Bible on January 20th every 4 years is the winner. Of course he lost.
Trump lost the 2020 election.
Okay. Joe Biden's the president. I don't think it was a good run election, but I also think Republicans didn't fight back.
That was the governor of Florida, Ron DeSantis, speaking with NBC. TK making his position pretty clear, I think, on the state of the 2020 election.
A lot of clarity there. Yeah, and I think the clarity is beginning to click in. And, you know, the calendar's out and, you know, it's completely foreign to the wonderful process of the British elections. But, you know, it's August. Get out the date calendar. Well, how clear are they going to be in November? How clear are they going to be in late January of next year?
That's the playbook, though, isn't it? Just a little bit of a subtle nod at the same time by saying it wasn't a very well-run
Well, they got
election,
constituencies to play to.
Just a little nod there.
And what's interesting, and, you know, this is a sidebar to what we're talking about right now, is I wonder what the language differential there would be from DeSantis, the governor of Florida, and Rubio, the senator from Florida. That's a real nuance there of constituencies.
And how this plays out on the debate stage, Tom. What are we, 2-3 weeks away from this?
Yeah, and we're going to have full team coverage, and, you know, we'll go there. There's a headline. You talk about, John, you know, the headline flow. You mentioned UPS earlier. We'll get to the New York Times later. Dish Network will merge with EchoStar. Maybe like a mating under stress.
Yeah.
You know.
Well, I'll try and get some more detail on that in a moment, Tom.
You know, I just think it's a really interesting August here amid deflation and also the quiet of politics in Washington. Look at the Washington Post. Look at the New York Times. The news flow is next to nothing. A good time to talk to Wendy Benjaminson of Bloomberg News here on her sleepy Washington. I want to play off the governor of Florida there. It just won't go away. I mean, this question about January 6th and all, and I guess George is coming up here with an indictment and all. It doesn't go away. How long away is this debate? For these people that will debate the end of the month, is it tomorrow that they debate, or is there a huge news flow to get to the Republican debate?
Well, I think one of the news flows ahead of the debate in, yes, an August where, you know, the Congress is out of town and people tend to be on vacation. But the big news flow is who will qualify for the debate. And we just learned this morning that former Vice President Mike Pence did finally eke out the number of donors he needed. And ironically, that last rush of donations came since his former boss's last indictment for trying to convince him unsuccessfully to overturn the election. So it's all wrapped up in one big messy knot here.
Wendy, as simple as I can, and you've got such great perspective on this. Does America care?
You know, I don't think voters do care. I think there's a small subset of Republican primary voters who are into this. There's also the small subset who are still moved by the quote-unquote anti-woke campaigns of candidates like DeSantis. and Vivek Ramaswamy. But really, voters care about putting food on the table, about having a job with a decent wage, and that's what gets people to the polls in the morning. It's not about what's happening to some group of people they don't know or to an election that was now almost 4 years ago.
There's a narrative right now that regardless of what happens, Donald Trump keeps consolidating the Republican power behind him and the Republican voters and has the most likely chance of becoming the Republican candidate. Increasingly, you hear candidates pushing back against some of his claims, pushing it back against him, including that Ron DeSantis clip we just played, where he said, yeah, Joe Biden is the president. No, it was not a bad election. How much does that hurt these candidates versus help them later on? Right? I mean, is there some sort of feel of what this does to the field?
Right. Well, I think, Lisa, you've actually set it out really nicely there, because there's the first hurdle of winning the Republican nomination. And then there's a much different hurdle of winning the general election, where you have to appeal not only to diehard Republican primary voters, but also to moderate Republicans, to independents, to that, mythical suburban vote, and hope to get some Democrats over to your side. And you're not going to do it in the general by saying that Biden was illegitimately elected. But first you have to get over that first hurdle. And I think you saw DeSantis in that clip trying hard to kind of find that hair splitting that he could do. Well, sure, whoever put their hand on the Bible is the president, okay. And then when pressed, he's like, yeah, Trump lost. I mean, we all know it, but it's become part of the GOP political rhetoric that maybe he didn't. And that's the thread they're trying needle they're trying to thread right now.
I just want to switch gears just a slight bit, because this morning we've been focusing on UPS coming out and talking about how their expectation, the full year forecast, is lower than expected because of Teamsters negotiations, because of what the deal was that they struck with the union. Is there any sense of how much President Biden will lean into the union push, his, the most union-friendly president on record in this election cycle? How much is the White House talking about this?
Well, they are talking about it. They think they're talking about it enough. It looks like members of the UAW this morning don't think he's talking about it enough. The president of that union really wants the president of the country to weigh in more forcefully on labor issues. I mean, Biden has always made himself Union Joe, Scranton Joe, the middle class, work union member guy. And he is not getting that vote back. Also, the Democrats need that blue-collar working people to win the election. Sorry.
Well, it's really interesting to see. I mean, you go down from the fancy Hay Adams Hotel, and, AFL-CIO's got their throne there near the St. Regis Hotel. Wendy, as simple as I can, is union Republican or Democrat?
Union rank and file tends to be Republican right now. Union leadership is Democratic. And that's what both sides are trying to reconcile. It turns out, the union leadership were all for Biden last year, while the guys actually in the factories, men and women in the factories, were voting for Trump. And so it's they've also got to sort of get their own house in order before they can be a real political force.
Wendy, thank you. Wendy Benjaminson there, down in Washington, D.C. There's some tension, Tom. Union leadership and the people actually working in the factories. It's a big deal. It's a big deal.
Is it like this in England? I mean, is it the same thing in England where there's this new management partition?
It can be over certain issues, sure.
Yeah, this is a huge deal. And Sean, the head of the Teamsters out of local, I think it's 21 or 25 in Boston, really alluded to this. And that there's this huge divide still involved. And what the Teamsters did was get everybody on board. His revolution at Teamsters was to agree with the union, to agree with the rank and file. That was the big change.
The year is 2036. I've been living here 20 years, and Lisa, it'll be the same question. Like
100%.
I haven't lived there for so long.
Exactly.
But yes, it is to some degree, of course.
Yeah, of course. You're going to get that. And in Europe, when you were in UK, when you were part of the Teamsters, what are they called?
I was not part of the Teamsters.
You were the leader, remember?
Not a union
That's
guy.
What we were doing it last year. Remember?
This is important. Our stereotype, John.
Not revealing my politics, but,
Our stereotype is the United Kingdom is much more union than America. Is that wrong?
I think the direction of travel is pretty clear in the States, Tom, from the 70s to now. It's declined a lot. And I think it's easy to say when you're in government at the moment that you're a union guy, when hardly anyone's in a union compared to 30, 40 years ago. Because would you be a union guy if we had the immediate pass-through from headline inflation into wages like we did in the 70s? Would that be a decent position to take on the economy, Lisa?
Would you be a union guy if UPS had shut down, if they hadn't struck an agreement, and then you had to come in with something that might have been punitive that led to that direct pass-through to rates that
Kill the
people paid
strike,
to? Exactly.
railroads.
This is a difficult moment, and you are seeing it in Europe probably more pronounced than in the U.S., but you do have to wonder who they're going to go, what companies.
For me, the real test of a so-called union guy is whether you actually allow Labour to strike. Like, that's the real test of it.
And you don't. No, you mean the president.
I'm saying to the president, that's going to be the real test of the president.
Yeah.
Have we seen
that? That's true. No,
happen?
we have
No,
not.
it's easy to say, I'm a union guy. Let's see if you're going to let them strike. That's the real test.
I would agree with that.
Equities right now negative on the S&P from New York. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Equities negative here on the S&P 500. We're down by 0.7%, pulling back after snapping a 4-day losing streak on the S&P 500 in yesterday's session. The Nasdaq down by 0.8%. A lot of attention on Apple. Longest losing streak of the year so far. 5-day losing streak. Could be 6. We're down slightly this morning at the pre-market by 0.2%. I'll talk about UBS in just a moment. UPS is down by about 4.9%. Underperformance on the Russell, the small caps. Equity futures down across the board here. In the bond market, 2-year, 10-year, 30-year. Bit of risk aversion out there, I have to say, without an obvious catalyst, without the exception of maybe what's going on with Moody's and banks, but not a lot stands out here, apart from perhaps throwing some China trade data. I don't know. We're down 10 basis points on a 10-year, 398.59. On a 2-year, Lisa, negative 4 basis points to about 472. Pick your poison. What is it this morning?
I am very curious, and I'm curious to hear this from our next guest, whether the real institutions have finally started to come in, given the fact that yields got to that 4% level. There was sort of this tentativeness. What are we missing? And it seems like people are saying, they're just getting over their skis with the inflation calls. Let's buy. Let's lock in 4% yields.
A bonds rallying going into this. Under surveillance this morning, a deluge of Treasury auctions set to test investor appetite.
So made you do that.
$103 billion of 3-year, 10-year, 30-year auctions being held this week. The biggest round of refunding since last year, Tom. The 30-year
Okay, who's going to
Thursday,
show up?
10's Wednesday, 3's today.
Who shows us? Does Japan show up? Is that the tension, Lisa? You're expert on this.
Well, I mean, I think that some people speculate there will be fewer Japanese buyers, but that's a long kind of process. That's not going to be now because yield curve control has been abandoned. That kind of, drama isn't going to be there. There is a question about whether the bond vigilantes are going to feel emboldened based on the Fitch downgrade of the U.S., based on how much there was a surprise upside in the amount of debt that the Treasury was selling.
In an auction deluge, is there a difference between 10-year demand and 7-year? I mean, who owns 7-year paper? 7 years, like only Invesco buys.
Well, that's going to be the real test of this docket of supply, Tom.
Yeah.
The additional supply that we got from Treasury that was announced last week, the real test is going to be out on the long end. Because the sell-off we've seen so far has been on 10s, on 30s. If you look at the yield curve and the inversion, deep inversion, 2 weeks ago, negative 100, right now about negative 70. All of that re-steepening, if you want to call it that, Lisa, has come from the long end of the curve. And it's not just the downgrade. It's not just the supply. It's the BOJ. Pick your poison. There's a lot out there that's come together that's pushed this Treasury market in the wrong direction.
Real yields are rising substantially. You're also seeing inflation expectations of the longer-term rise. Is this time different? Where suddenly we do get a reacceleration of inflation in a new era of monetary policy restraint, really, and actually having rates higher than they had been over the past couple of decades.
I mentioned the downgrades, not Fitch, but Moody's this morning, downgrading 10 small and mid-sized U.S. banks, citing a dimmer outlook. The rating agency writing this: rising funding costs, declining income metrics will erode profitability. The first buffer against losses. Assets risk is rising, particularly for small and mid-sized banks with large, guess what, Tom, commercial real estate exposure.
I would look at CRE, people downplay it. They say, well, it's just office buildings, work from home and all that. I'm like, maybe. What I'd also look at here, John, is the tape. Equities, bonds, currencies, commodities picks up on this single news story, and it advances here in the last 60 minutes. Just to give you one idea, John, 10-year yield to 4 digits. It's a 3.98 handle.
So if you had to pick the poison this morning, Tom, you'd pick out this story for this move
China,
this morning.
China overwhelms it all, but it's a summation of stories here. It's, there's nothing going on. It's August. Barbie's over. We got to have things to worry about.
Barbie's still selling out.
It is. It's like gazillions.
It's nuts.
Sweeney says it'll pop $2 billion.
$2 billion, really? You've seen it?
I've been 5 times.
What's the review?
The kids loved it.
They liked it?
Yeah. I mean, it was
Come on, Lisa,
bubblegum.
What are you holding back for? Come
It
on.
had a good message.
PC Bramo.
Okay,
holding
no.
back.
to the
That's what you
radio.
think.
Okay,
Come
the
on.
truth is, it's a really thin story that's really irritating on certain levels and somewhat heavy-handed, but it has this sort of like nice overlay of sort of messaging. To me, it was like a 2-hour build-up to the last line, that was the punchline.
What was the punchline?
That Barbie was going to see a gynecologist.
That's the punchline.
Can we say that on radio?
Are you serious? That's the punchline.
Yes. Let's move on.
I don't get it. What's it? What does that mean?
You've never
It's
had
a little
Barbie,
dry
have
British
you?
humor there. It's
No, I
lost
don't
in
think
translation.
it is. I don't think it is.
What's the significance?
Well, Well, that
Why is
she's
that a
actually
punchline?
become a woman, and when the plastic doll is, anatomy-less. So it's sort of the concept of her becoming what it is to be an actual woman rather than the image that was sort of foisted upon the girls that were playing with the dolls.
Tomorrow, folks, the Bramo review of Oppenheimer.
Let's not do this again.
You just defined what a woman is. That's it's shaky ground these days. You know that, don't you? UPS shares slumping. The company lowering its full-year profit forecast as it deals with changing consumer habits and rising costs. After a tentative Labour agreement, the stock is down by 5%. The company now expecting revenue to be 93 billion down from its prior forecast, Tom, of 97. That's a cut to the outlook this morning.
It is. It's important to me. It is logistics. It's like FedEx. It's a real thermometer of what's out there. But I'm going to go to the labor cost headline that we saw of Teamsters is a real adjustment of selected companies to come, including all the tension we see in UAW. What's this do to Ford and GM?
Yeah, and others too, Tom. And then we've got the story tomorrow, isn't it, after the close, the Walt Disney Company? Yeah.
Task Force.
Task Force from Reuters.
Task Force, don't get me going.
Focused on AI.
Look at New York Times today, out with bang up earnings, no
though.
tax.
AI in the media, that is a big, big deal.
Oh,
That's
yeah, it's a
big,
thing.
big deal.
You go to lunch, you go, AI.
Have you seen those videos where they can do like a mafia version of Harry Potter? You can just
No, I've not seen it.
I actually didn't. That didn't come on my timeline.
You should check that out. It's fantastic. They can do really, really cool things with this stuff now. Do you need the actors, the actresses? And that's where the tension is right now between the striking Hollywood stuff and the Bob Igers of this world who would like to, I imagine, I'm not speaking for him, but you'd imagine if you were running a media company, you'd like to just clear the decks of some of the costs. And Tom, there's a strategy there to be had.
You want me to Segura here?
Please.
I'm Segura here. Just S&P futures negative 35. To be clear, the tape deteriorates. This is an important interview, without question, our interview of the day in fixed income and all that it means across equities, commodities, and foreign exchange. Rob Waldner is out of the vintage of Newtonian calculus. That would be engineering at top East Coast schools with a heritage back 200 years. He's Princeton civil engineering, and that is a rigor about statics and dynamics that he brings to fixed income right now. This is not statics in the fixed income market. What is the dynamic of all the algebra, the math of fixed income right now? What's the dynamic that you're focused on?
Well, Tom, you were talking about it earlier in this in the show, which is the news around disinflation and almost sort of seems like deflationary sort of vibes that we have out there. So we're getting U.S. CPI data on Thursday. We get Chinese data tonight. Chinese data CPI is likely to come in negative year on year. U.S., I think the Bloomberg consensus is we'll get a 0.2 on core and 0.2 on headline month on month. So the data is starting to come in as we've been anticipating, very disinflationary, and it looks like, certain areas like China and the trade data we got overnight feels more like deflationary. And I think that's what's going on in the bond market here, is people are finally realizing or looking at that and thinking, hey, if I can get a 5.5% for an investment grade bond portfolio, and we are in a disinflationary environment where where growth is going to be, mediocre, that sounds pretty good, right? So that's where the buyers come from.
So there's a tug of war right now between disinflationary forces and additional treasury supply. You don't think that treasury supply wins out? You don't think it's as important as the disinflationary forces when it comes to what this bond market is going to do?
Day to day, the treasury supply can drive things, and I think you were talking about it earlier. That's probably part of what's revalued things last week, is looking forward to that supply. But we know that in any medium-term, month-type horizon, supply is not the driver. It's the macro forces that drive real yields.
So have you been buying this bond sell-off?
We have been, we are positive on duration. We've been looking at this treasury, if you want to talk about the treasury for a second. We think the 10-year has been in this 3.5% to 4% range. I'm actually getting a little more positive than that. So thinking about that here is a great buying opportunity because, one, as I said, you have a disinflationary environment with relatively moderate real growth. And so that in the medium term, that's quite good. And then if I start to think about the risk scenarios are that the Fed overstays its welcome here. We have several Fed members saying they think they need to hike again, even though we believe we're in a disinflationary environment. That could be quite negative for the growth outlook. That could create a dislocation, and that would be very positive for the Treasury market.
So, in other words, when we're talking about these auctions this week, are you basically saying, yes, let's go? I can't wait to load up on both 10-year and 30-year Treasuries.
I think that, this is a great time to buy fixed income. And if you want to buy Treasuries, if that's your asset of choice.
So who is coming in and joining you? Are you seeing more institutions who are doing the same thing that you are? Or is it still the international buyers, still the same buyer base, and that we're all just making a lot of noise over nothing?
Well, you have the same buyer base. The same international buyer base is still there. Fixed income flows have not turned incredibly positive yet, but we think that's likely to come.
Can we talk about the new floor in global fixed income? Now the BOJ is pulling back, the ECB has pulled back, the Federal Reserve has taken rates to 5.5%, and people think maybe they only come back to maybe 4, 3.5, something in between. What is the new floor for global fixed income? If you get into trouble, what do you rally down to, just in terms of yields? What are the limits of that rally? Because people don't think it's zero anymore. What is it?
Well, we'll have to see where that pans out, and it depends on what a recession looks like, how far we get down.
If you develop thoughts on that.
But we think that it's something in the range of sort of a more normalized yield curve would see, a more steep yield curve, and if short rates get down to 1, you're talking about 10 years at 2, 2.25.
You think short rates will potentially come back down to 1?
In a recessionary type environment, yeah.
Interesting, because Lisa, the kind of pushback I've heard is that perhaps you come down to 3.5, 4, something like that. I think that was Mike Gapin's point over at Bank of America.
That essentially inflation would be stickier for longer, and that would keep the Fed at a higher level, that they weren't going to go back to the low rate kind of environment. And I just wonder how much this is really the poles of the debate right now, people who believe we're going back to the environment we were in before, and those who say this time really is different.
What are we going back
to? I would really point, we live in a nominal world. I think sometimes we get confused by this real and break-even stuff. We live in a nominal world. Nominal growth is coming down very, very quickly. So inflation's coming down and growth is coming down. So, if you think going forward we're nominal growth somewhere in the 4.5 type of range, that's a tremendous environment for fixed income, right? And if nominal growth settles at something below that, then you could see rates come back down.
Rob, this was great. Thank you, sir. Rob Morgan there, Vivesco. Good to see you in person.
It's great to be here.
Isn't it? It's unusual. I think it's been a few years, right?
Since I've been on this set, I think,
Crazy.
or this new set.
Rob, thank you.
It's not new
Which
anymore.
is not so new anymore.
Yeah, exactly.
I've had this a few times, right? We've had this a few times over the last 6 months where we just haven't seen people in person for that long. If you are just tuning in, welcome to the program. Equities right now negative by 0.75% on the S&P 500. Coming up at about 8:30 a.m. Eastern Time, Stephen Stanley, chief U.S. economist at Santander U.S. Capital Markets and one of the most accurate forecasts of the labour market on the street, Tom. That conversation just around the corner.
I can't tell you how timely this call is to see what we get as an adjustment from Mr. Stanley, and I'm going to go again to this price overlay. And, as Michael Darter would suggest off of what Rob Waldner just said, is you get real GDP to flatten or even come in a little bit, fine, no big deal. But if the inflation component comes in, all of a sudden you have nominal GDP under 5%. I can't fathom it could get under 4%. And that's where you get back to what Ed Hyman, among others, has been talking about, which is a real disinflationary tendency.
And other people say that
and the Fed reacts.
Because the economy has been so resilient, because of the fiscal stimulus, because of the unwillingness to really cut the budget, because of the debt overhang, suddenly you end up in that higher inflation, higher rate kind of reality. These are the poles of the market right now. We don't know where we're going. And this is the reason why actually I care less about what the Fed is saying in the immediate term and more about longer term, any kind of benchmarks to understand where we're heading.
Chairman Powell, later this month, potentially at Jackson Hole.
All right, I am interested in that. I mean,
it's one to watch.
You think he's going to show up?
Potentially.
John, seriously, 7-minute speech.
No,
first
I've not said
no
I don't
harm.
think he shows up.
No. You were saying you wonder if he shows up.
No, I wonder if this is the right time to make some kind of defining comment on the disinflationary forces we've seen so far.
That's
when
a
you
fair
just
point.
have the luxury of waiting for one more print after this one before September 20th.
That's a good point.
That's my question.
He could come out and just say, "Look, I don't know.
Yeah,
you don't know.
He has the luxury. He has the luxury of waiting.
Yeah.
And I think nobody's sort of like dying to hear from him later this month.
Exactly. So he can really underwhelm.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
what do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
I think it's actually a weaker dollar forward. I think the FX market is in kind of a tough spot at the moment in the sense that it's difficult to really navigate a lot of these cross currents. The Fed has the ability to start pivoting towards the end of the year. That's the dominant driver for the FX market.
Everyone talking about Barbie in my ear, distracting me. I haven't seen it.
I haven't seen it.
Just give me a chance, then you get my review.
You're going to see it?
I'll watch it eventually, yeah. It's not the kind of movie I feel like I need to go to the movie theatre to watch. I watch that at home.
In the privacy of your own home where no one can see you watching Barbie.
And then I might have things to say, you know, after I've seen it. I'm open-minded about what the movie's going to be like.
I think you should be. I'm looking forward to your review.
Good. Vasily Serebryakov there of UBS on other things, not movies at the moment. Equities right now, down 0.75%. Bit of a sell-off this morning. Stocks are lower. Data out of China, not great. Downgrades of US banks by Moody's, 10 and small and medium-sized lenders in America. Talk of a banking levy over in Italy. So the mood's just soured, I would say. There's a rally in the Treasury market. Tom, yields are down 9 basis points, and the dollar's stronger. Euro dollar 109.44.
It's a reversal. Rob Waldner of Invesco just moments ago talking about the overlay here of disinflation, deflation. I mean, these are tangible things. Let's be clear on this. Inflation for real. Disinflation is just less inflation. Deflation's actual price decline. See Europe in the 30s. Reflation's a cosmic thing. It's not really an economic concept. Nobody's talking about reflating, even though we've stimulated our way maybe to one big reflate over the last 5 years.
We're certainly talking about weaker growth out of China at the moment, that's for sure. That's for sure.
We're going to do that right now, and we're going to get a terrific brief linking in the markets into the economics of the moment. Damian Sassower joins us, Chief Emerging Markets Credit Strategist at Bloomberg Intelligence. He has agreed to appear this morning on Bloomberg Surveillance if we don't bring up the dreaded New York Yankees. China, the COVID. They came out of COVID. Things are going to be great, and then not. What's from 60,000 feet? What's the why of the immediate slowdown we see in China?
Well, Tom, thank you for telling me what disinflation is. I really didn't know that. And deflation.
Why do people confuse them?
I get confused. I get confused. I get confused. No, seriously, the data overnight. I forget about exports and imports. The data overnight out of China. I'm talking foreign direct investment, which a lot of people aren't talking about. Down 87% to its lowest level since 1998. Remember what China's exports are. 30% of all Chinese companies that export abroad are foreign companies operating in China, right? So that 30% of that number. So when you see, exports are down 14.5%, we knew it was going to be bad. It's the supply chain diversification theme that is really kind of resonating with me. The fact that it's, foreign auto deal like Mazda and Mitsubishi are basically scaling back operations in China, like Stellantis, et cetera. And so, for me, it's just more of the same, obviously imports are down. We know the weakness domestically. We know the property sector bubble. Did you hear that Country Gardens defaulting on, coupon payments this morning? Go figure. So a lot of that hasn't changed. But, again, it's how is it spilling over into the broader economy? And this is where it gets interesting, because if you look at the major emerging market currencies, all 22 of them, over the last 1 day, 1 week, 1 month, and 3 months, not one of them is up. And this has a lot to do with the yuan.
It's like the economy that cried wolf. We've seen signs over and over again in certain periods of an economy that's going into something difficult, something bad. And it looks like all the ingredients for a balance sheet recession, but no one really wants to engage in that conversation because they feel like they've had it multiple times over the last decade and they've been wrong. Does it look like this is going to be a balance sheet recession in a place like China, given what you're seeing play out right now?
I guess we call sub 5% GDP growth year over year a recession in China, right? Because that's really what happened. I mean, let's think about where we were in the beginning of the year before the reopening. It was going to be, 4% growth in China, which is dreaded. It's awful. It was going to be terrible. Then everybody scaled it up to 6% on the reopening, and now we're back down to people talking about maybe it's going to be a 4% GDP growth handle for full year 2023 in China. It really doesn't matter what the number is because they are not stimulating the economy. They just can't get sentiment right. This is cyclical, And so for me, it's, if people don't want to consume in China, if people don't want to buy, you're just going to see, we all talk about the inventory stock up during the COVID window that all these industrial companies in China kind of did, and now they're kind of working their way through that, and that's what's leaning on inflation, leaning on deflation, pushing that kind of narrative through. But it's just really, really tough on the ground. And our friends at China Beige Book, they do a great job on this, and they have some alternative indicators that we look at. Things are not good in China domestically.
Forget the GDP number, you're right. What I really want to get at is whether we're seeing the essence of a balance sheet recession, where you can't really stimulate your way out of it because you're just going through this period of deleveraging. Is that what the consumer is beginning to go through, this period of deleveraging? It doesn't matter how attractive you make that second, third, fourth, fifth property to me. I just don't want to buy it.
Japan. Yeah, the Japan dilemma, basically. And I can't really comment on that because it's just really hard. There were so many different structural and mechanical factors in Japan that makes that case so different than what we're seeing in China. China can grow its way out of this. They really need to stimulate again. And what's that going to do to their fiscal state? Remember, China's fiscal deficit to GDP is actually coming down despite all the rhetoric and the talk about how they're going to stimulate the economy. So, what's next?
And then there's a question of the read-through to the rest of the world, both with the developing world, which I know you track very closely, as well as in the developed world. I think about the U.S. This from the Census Bureau. U.S. imports from China were down 24% during the first 5 months of 2023 versus the same period last year. Chinese products accounted for roughly 1 out of every $6 Americans spent on imports, down from nearly 1 out of every 4 pre-pandemic. How much is this a U.S. disaggregation from China, and how much is this a global, we're not going to rely on you in the same kind of way?
Such an important point, because you're right, 23.1% decline in the U.S. It's double digits across the board. I'm talking the EU, Japan, Brazil, Australia. All of them are double digit declines year over year in exports out of China this month. So, look, it's more of a global. It's more global is really what I'm trying to say here. It's not just the U.S. The supply chain diversification theme is real. It has to do with Beijing's interaction with foreign companies. Look, you really think Beijing cares about the profitability of its local Chinese companies, Tom? They haven't shown any willingness to want to bail anyone out yet. Yeah. So, I think it's suspect.
I got 8 questions going to China, but something's more important. Bloomberg Business and Sports, you work with Michael Barr and Scarlett Fu. John Farrow was absolutely flabbergasted that a sports announcer for an American sports team could be fired by their team. And I tried to explain to him the heritage here, going back to Dizzy Dean, Vince Scully, and the rest of it as well. The Baltimore Orioles had an announcer who said, not negative things, but just stated some facts about their wonderful season. And it's all blown up for the greatest story in baseball this year, hasn't it?
Well,
Tell me about free speech and announcers in sports.
Well, look, the Major League Baseball is doing a lot of things right. I don't want to talk about what they're doing wrong. They've changed a lot of the rules. We've had Randy Levine from the New York Yankees on. Everybody's pretty happy. Have you been to a baseball game yet this year? They're 2 hours. They're amazing. Right. It's a wonderful experience.
Why would the Orioles do this?
But why would the Orioles get rid of their announcer? I don't know. I'm not a Baltimore fan. They're having a pretty good season. I love Camden Yards or the new stadium. Where are they playing now?
Does Michael K. Kay get told what to do with the New York Yankees?
I think Michael Kay is far smarter than, he doesn't need to get told what to do for the New York Yankees.
John, is there an English analog here?
He's kind of like you all. He knows exactly how to answer these questions. He knows where he gets paid from.
So Kevin Brown basically just highlighted how poor the Orioles were against Tampa, their record.
Yeah.
And then gets suspended for that.
Can't be the only reason.
It doesn't make sense to me. Are they propagandists or are they meant to be commentators?
You're
They just
looking
highlighting
at
the facts.
Marino. I don't know what the Orioles is. I have no idea. I mean, but look, if you want
Bizarre.
to, I mean, it sounds bizarre. I have to read up on it. But look, what I will say is we had the pleasure of AC Milan's chief revenue officer was on Bloomberg Business and Sports last week. We asked him a few questions about what's going on.
He wasn't invited.
Well, we wanted John, but he was too busy. You know, John was.
They spent a lot of money this summer.
And a lot of properties he's managing right now for Bloomberg. So
trying to.
Yes.
Very difficult.
An invite would have been nice, but you know. Spent a lot of
I
money.
think
We had Jerry Rice on. You know, we had Jerry Rice on yesterday, and his daughter, Lovely. They're marketing some new goat fuel, a new energy drink. Really fascinating.
Goat fuel?
Goat fuel, because he's the goat. He's the greatest of all time. Jerry Rice, wide receiver, San Francisco 49ers.
Very good.
I was picturing an energy drink.
One big shameless plug.
There's a goat on the drink. There's
okay,
definitely a goat on the can.
Goat fuel.
If
Yeah,
Joe
goat fuel.
Castiglione
I was-
mentioned that the Red Sox had done poorly against the New York Yankees, they would have been like, that's life.
Is there goat fuel in
John
London?
Farrow, the foreigner's 100% correct. It's a complete, total outrage that they went after that guy for something that,
foreigner.
if he showed up drunk, that's different.
The Orioles have a history of making a mess of things, don't they?
Who's the
Blowing
animal?
up the
It's
season.
Orioles
It's
in the
unbelievable.
UK.
Yeah.
I'm introducing you as the foreigner when we go to London in a few
Do
weeks. And Damien, it's
And
good
I
to
feel
see
like
you.
I'm a foreigner when I'm there.
Damien Sassa, you love it. You fit
Do you know
right
that
in.
every cigar bar I go in, everyone's for Arsenal? That's what I've learned.
Which cigar bars are you going to?
There's a
Arsenal
little
ones.
cheap one over there. It's on the west side. It's a
Okay,
little,
in Mayfair.
yeah, it's
A
like
little cheap one.
the
Yeah, I know it.
Langsforth or Longsforth.
Cigar bar. What do you expect?
Okay.
You know.
You back on the cigars?
Yeah, we like cigars, you know.
Okay.
We have a celebratory cigar.
What, once a week or?
Once a month, once every
I
6
don't
weeks.
believe that. I can always tell. I get the call from TK in the afternoon, and you can just tell when you're.
Yeah, well, I
smoking
got
a
the
cigar.
dog. I got
just
the
hear
vet
it in
bill.
the breathing patterns.
I got
just
the vet bill and
in the
kettle
cadence
fee,
of
and
your
you know,
voice.
we're hanging. Yeah, you know.
Okay.
Yeah.
Okay. Mira Pandit of JP Morgan Asset Management joining us shortly. Damien, thank you. Thought you were coming on to talk about China
He
and
knows.
emerging markets. Get real. From New York, this is Bloomberg.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lines.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
insight
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And the Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
We are in recovery mode, and the shape of that recovery doesn't look so fantastic.
This equity market never priced in a recession into earnings.
It's difficult to really navigate a lot of these cross currents.
We're not terribly optimistic that we will get this true soft landing.
We've been in the soft landing camp, and I still hold to that view. And I think when you think about soft, there's going to be bumps.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is a busy Tuesday on radio and television worldwide. Across this nation, deflation is in the air. John, it's a summary of what we've heard from everyone. I thought Rob Waldner at Invesco was just brilliant on this. It is the overlay in his fixed income calculus.
It's a blend of stories, Tom. Data out of China this morning, not great. Imports, exports, terrible. That's been a theme so far the year for China. Downside surprises. Throw in some downgrades for some US banks, Tom, 10 of them, small and medium size from Moody's, and maybe even more to come. Throw in some debt supply, Tom. 3-year today, 10-year tomorrow, 30-year on Thursday. The toxic brewers, Brammer might call it.
Yeah.
Equities are down this morning by 0.7 to 1%, TK. Pick your poison.
The toxic brew here is that tension that's out there, and yet Bikram Chadha of Deutsche Bank came in here and said, pull back. And that's the other side of it, like Eli Lilly's earnings today. A lot of negative earnings like tone, and yet Eli Lilly comes out with a better than good earnings report, and that's what Binky Chadha is talking about.
Called it a wobble. Called it a wobble. A wobble.
Sounds
UBS,
better with a British accent.
UBS having a wobble.
Wobble.
The stock is down by 5% at the moment. How long do I need to live here before you just treat me like a local? You know, like a New Yorker, like one of your own.
Lisa, come on,
How
you
long
can
do I
answer
have to be
that.
here?
I'm not. I don't feel like a local
Well,
here.
he's asking you specifically. I don't
Yeah,
think he's
but you're the
asking
New
in this
Yorker.
generic way.
But you're the New Yorker.
Yeah, but I think
You
the thing
adopt
about
me
New
after
York,
a few years.
the New York spirit
years?
is that people who come here and consider themselves New Yorkers are New Yorkers.
Thank you.
That is the spirit of New York City.
There
New
we go.
Yorker. Thank you very much.
Good morning, Mayor
Carry on.
Adams. We welcome all of you across the nation. Please visit New York soonest to talk to New Yorker Jonathan Farrow. Lisa, we have auctions. I don't care. Explain why I should care about auctions in the coming days.
You started the show saying that it's deflation Tuesday or disinflation, and that's the vibe. That is really the key question, is it? And a lot of people aren't buying it, and that is the reason why these auctions are so important. If you have the world's biggest economy with a debt overhang like the one that we have at a time where unemployment rates are 3.5%, doesn't that lead to inflation? Doesn't that lead to at least higher rates and people not wanting to buy the debt that has to be sold in greater quantity? If you do have any kind of buyer strike, how much does that lead a real risk-off feel across the market? Rob Waldner not buying it. He's loading the boat. How many people are going to join him?
One idea to get to the data, John, and this is the foreign exchange market. I'm sorry, we creep stronger dollar. I'm watching Euro Swissy, John, to see if we get strong Swiss franc, sort of the global disinflation, deflation angst, a little bit of that, but I'm not there yet.
There's some risk aversion out there, Tom. Stocks down by 0.8%, actually near session lows, an hour and 27 minutes out from the opening bell. The bond market rallying, yields are lower by 9 or 10 basis points. The 10-year 3.98.99. Tom, you went to the FX market, dollar stronger by 0.5% against the euro, 109.43, and crude pulling back to about $80.11. We're negative here by a little more than 2%.
Good morning, everyone. With futures again deteriorating, -35 down to -36 as well. We're going to get a brief on these markets right now, and I love what she says about August and summer. Mira Pandit with us, global market strategist, JP Morgan Asset Management. You'd said, Tom, you're jogging in place. You sound like the entire Keene family, because that's what I do. I jog in place. What does jogging in place mean for a market that's been a moonshot since October?
When we think about the market and the risks here going forward, there's not a whole lot of upside risk here, but I think that the downside risk is somewhat limited, because if we think about where we are with the markets, we are in between the inflation spikes and the Fed hikes, but also waiting for the economy and profits to sour. So I don't know that there is a whole lot of upside catalyst in a world where profits are just better than feared. We need to see some more out of the profits landscape in order to get some more upside from stocks that have already rallied really hard and that have already experienced some pretty high valuations. But at the same time, until we see some more souring in profits in the economy, I think we're in an environment where stocks are essentially jogging in place where we are today. Right. And that's not just for stocks. I think it's similar for yields. The pop in yields we've seen more recently, I would attribute that mostly to the pop in growth. Yes, there was a Fitch downgrade. Yes, we're seeing some inflation break-evens move a bit higher. But really, it's all about growth if we think about this higher yield environment since the May FOMC meeting. So if we consider that environment, I think that yields, too, for the rest of the year could kind of jog in place until next year.
You're charm at JP Morgan. This is English major out of Tufts CFA, which I think is the coolest thing going. I can't imagine what the CFA was like for you coming out of that wonderful background. You write the documents at JP Morgan. You actually craft the documents that you're putting out. What are you writing right now about 60/40?
Right now, if we think about the 60/40, it's had a huge rebound over the course of this year. Last year, the 60/40 was dead, but I think what's important to think about with diversification is that markets and the economy look in opposite directions. Markets are very much forward-looking. The economy is at best looking at where we are today, but also looking backward at the data we've already seen. And if we look at periods in history where the 60/40 has struggled, take 2008, take 1974. If you look at the next year, 1975, if we look at 2009, those were by no means good economic years, but you did see the markets rebound. I mean, 2009 is a great example where you see markets bottom in March. We start to get out of recession in the summer, and actually the unemployment rate continues to rise until October. I think that's a helpful guidepost for where we are today, in that the market has priced in a whole lot of bad news and a lot of risks and threats, and we have yet to see all of them crystallize, but the market is already sort of looking a little bit beyond there, and that's a good environment for diversification.
What do you say to a client who theoretically comes up to you and says, hold on, this time is different. Inflation's going to accelerate. These bonds are going to be worthless. It's going to wreck our valuation of the stocks, of the stock holdings that you currently have. We're focused on something that's really problematic. We want to just hide in cash. I don't see how you could be calling for yields to go back down to something that was normal. What do you say to them?
Ultimately, if we look at cash right now, clients love a guarantee. If you can get a guaranteed 5% in a CD, that seems great. But the reality is, if you think about something like a 6-month CD, you have some reinvestment risk there when we think about the arc of the year. And with yields where they are now, with above trend growth, well above trend growth, really for 4 quarters in a row, if we even start to see slightly sub-trend growth, you're going to start to see yields come down. If we see inflation soften a little bit more, you're going to see yields come down. Doesn't mean they need to crater this year, and again, they could be jogging in place a bit, but as we head into next year and we look at that 12-month outlook, yields can start to come down. So when you sit in cash, you have this opportunity cost where your income can potentially come down, but also you don't get the benefit of the upside. Within stepping out a little bit in the risk spectrum to bonds, you can potentially lock in income for a longer period of time, and in addition, have that potential for capital appreciation.
We've been talking about the auctions this week and how the U.S. Treasury Department is selling a greater amount of debt. Are you saying this is a good time to buy? That 4% on a 10-year yield, to lock that in, seems like a really nice opportunity.
The window for the bond market has been extended over the course of the summer. It is, of course, a setback in terms of that recovery that we were hoping to see throughout this year, but it does extend that window of opportunity from an entry point standpoint. One of the biggest challenges that investors are dealing with today is price. Where do you find something at a reasonable valuation? Now, I will fully concede that if we look at debt and deficits over the next decade plus, with deficits coming in at 5.5% to 7% on average. That is historically high, and we are going to deal with a yield problem over time. But I think, given the economic backdrop in the near term, this is a pretty good entry point.
What does it sell right now to high net worth people about cash at a 5% yield? Are they comfortable with that, or are they saying, wait a minute, why can't we buy more Apple?
You see that clients are comfortable with it because, again, you haven't had that type of yield in so long. But I think getting back to your question about the 60-40 and how we broaden out that allocation, we're also seeing that people realize this is not a market for easy money. It's not just that you're going to experience beta that's going to go up. So people have to be a little bit more discerning in how they're investing, not only around the world, but in terms of types of vehicles, thinking about alternatives to enhance different outcomes for income, diversification, capital appreciation. So I think that people are really sharpening their pencils.
So you're saying this time active management wins. Into 2024, active management will beat index.
Take a look at profits, take a look at companies, even within the same sectors or industries. You're seeing a lot of differentiation in terms of how management is handling higher prices, higher wages, more headwinds thrown at them. So certainly it is a time to pick and choose which managers and which management of companies are doing the right things in this environment.
Mira, thank you. It's good to see you. Mira Pandit there of JP Morgan Asset Management. Just some breaking news in the last 10 minutes or so. I want to share that with you. The SEC charging 11 Wall Street firms with failures around record keeping. There's a range of fines here. I'll share some of them with you. Wells Fargo agreeing to pay a $125 million penalty, BNP Paribas $35 million, BMO, Mizuho, each paying $25 million, goes on and on and on from there. This is the line that stands out, and this is what it really is about. So, as described in the SEC's orders, and this is direct from their press release, Tom, the firms admitted that from at least 2019, their employees often communicated through various messaging platforms on their personal devices, including iMessage, WhatsApp, and Signal, about the business of their employers. The firms did not maintain or preserve the substantial majority of those off-channel communications in violation of the federal securities laws. So 11 Wall Street firms charged by the SEC on a failure of adequate record keeping, Tom. The fines themselves, though, not large for banks, though.
I agree.
10, 20, 30, 50 million?
Well,
not
but the
talking
sum
big
of
time.
it's 289 million, I believe is the number that I've got here. The font's a little small. 289 million is the all-in sum. I don't know if that's big or small, but this is an intractable problem, and Bloomberg has tried to deal with this with our IB. And IB is within the system, and you can keep the records in that. WhatsApp, or what are we calling a repost? If you do a repost, on X off of the 42,000 shares of Apple you just sold, how do you keep that record?
This directly goes to working from home, too. If you think about what happened during the pandemic and everybody using their own modes of communication, what does the bank that they work for have to regulate, oversee? How much do they have to turn over their phone, their texts, et cetera, to a bank that now is responsible for it? And this was a shot across a bow, and there are going to be a lot of real conversations about that.
Solution: when the market closes, you leave your phone at work and you leave, and no one can contact you.
That's not what we do.
That's what we should
You're
do.
right. No,
not even just for traders,
there's
that's
people,
everybody.
Seriously,
Everybody.
Exactly.
John, there's people that want to do that, but that's not the new world.
That's not the new world.
No,
Did you see that Zoom have told their
24/7.
employees to come back to the office?
That's hilarious.
I saw that.
Yeah, Zoom video communications. They're basically saying we need more people in here. Hybrid work, but do a little bit more of it in the office.
Never done Zoom.
Exactly.
Come on, never did Zoom.
Never done Zoom.
I don't think I've got an account with Zoom either. It was never that.
Seriously?
No. You could download the app and someone would send me a meeting and I would use it, but I never had.
The video on? You're one of those people?
never Zoomed.
Just, I might have been there, might not have been there.
Yeah, you're one of those people.
I'm one of those people.
I'm on
Is
the
that
camera.
A bad thing? One of those people.
Well, it's like the people who kind of want to hide some of their emotions, et cetera,
Yeah.
which is like,
here we
just,
go.
no, like on a Zoom call. That's always kind of like the group
You're
chat.
accusing Tom and I of hiding our emotions.
Yeah, you guys actually share plenty, but I am wondering whether, there is going to be a shift away from Zoom. I find Zoom annoying because of the delay.
Okay. If you're just tuning in, welcome. Equity futures right now on the S&P, negative 0.8%. Stephen Stanley's coming up, 8:30 Eastern Time, about 17 minutes away. Chief U.S. economist over at Santander U.S. Capital Markets, Tom, on the labour market and on the inflation data still ahead this week.
The price data front and center here with the deflation out of China today, elements of disinflation, as Rob Waldner said, the idea here of nominal GDP coming in, that's a good time to address that with Mr. Stanley.
With the bond market that's running hard, Lisa, and yields are lower by something like 10 basis points. This market, selling off this morning, can't really identify one single piece of information, Lisa, that's driving it. Tom mentioned the trade data out of China, the inflationary story later this week, the downgrades of US banks by Moody's. Take your pick.
How much are we going to start focusing on regional banks again? Do we have to care about that again? Are people going to be talking about the SLUs and actually caring about Senior Loan Officer Opinion Survey?
Moody's turned up the volume a little bit. Just turned it down, just a touch. We're talking about it. So we're talking about it again after not talking about it for 3 months, when that's all we talked about through March and into April.
Exactly, but that's my point. Do we start to care a little bit more?
I'm with you.
I don't know.
Equities down from New York. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We are basically overdue for a 3 to 5% pullback. It would be normal. Believe it or not, we are now running in, 95th percentile plus in terms of the duration, even though it seems rather short since March, since we had a 3 to 5% pullback. As I said, that's pretty normal.
Big chatter at Deutsche Bank on the wobble in this market. There's a wobble right now. Equities. Near session lows on the S&P 500, negative by 0.8%. A rally in the bond market, yields lower by 9 basis points. Commodities softer, crude to $80. We're down about 2.2% on WTI off the back of weaker than expected trade numbers out of China this morning. Downgrade to the banks out of Moody, 10 of them, small to medium size here in the United States, talking about risks around commercial real estate and all of the above. In the FX market, dollar stronger, just capturing that risk off tone, that risk aversion right the way through. Cross asset in this market, the euro back down to about 109.40, euro dollar negative 0.5%, even with the dovish tones of Patrick Harker, who is a voting member of the FOMC, Philadelphia Fed president speaking, saying the Fed will need to hold rates steady for a while. We might be at the point, though, where it can hold rates steady. And with this, Tom, the US economy is on a flight path to a soft landing, saying all the right things there. Some dovish tones coming out of Philadelphia this morning.
Before the inflation report, what is it, in 2 days? I mean, you're getting an inflation
Thursday.
report in 2 days, and we'll get another one before the Fed meeting, and they're slaves to the data. That's all there is to it.
Yep.
I don't know what else to say, and part of it was the data out of China today. It was shocking.
Are they slaves to that?
Yes, I think so on a global basis. Jerome Powell is, in honor of Bill Rhodes, central banker to the world.
Whether he wants to be or not, I guess.
He doesn't have a choice. That's the way It is. What we're going to do is dive in now with expertise at Bloomberg Intelligence. Long ago and far away, you did what you could to steal the research of Prudential Research and one Lee Klasko. He was read worldwide and across this nation on boring stuff like trucking and railroads in this strange word, logistics. He's senior logistics analyst for Bloomberg Intelligence. It's a gift we have him today. I'm going to conflate in here the bankruptcy of Yellow with what we see in UPS. Given these events, can they raise rates? Can they raise and sustain revenues by raising rates?
Yeah, I mean, that's what UPS is going to have to do. And they do have pricing power because at the end of the day, there's really two main competitors. It's UPS, FedEx, obviously the U.S. Postal Service. There's some smaller players, but they have the ability to raise rates. And not only can they raise rates, but they're also going into markets that are more profitable for them. So they're going to the small and mid-sized shipper versus the big enterprise shipper. So they're kind of pivoting away from the Amazons of the world, if you will, and going, kind of down market because those customers tend to be more profitable, and they're going into more profitable verticals like healthcare, which tends to make more money for these.
You don't do buy, hold, sell, John, but to me, you wonder if this is like back up the truck and load the boat.
I'm not about to do a buy, hold, or sell on that name either.
You back up the brown truck and load the boat right here.
Can we bring in the volume story into the conversation and just talk to me about what's happening domestically in America? Because we're hearing from some domestic-focused airlines, for instance, JetBlue, Southwest, mentioning that maybe things aren't as great as people are saying. What are we learning about the domestic U.S. economy from this company?
Well, we've been in a freight recession for quite some time, and that's really driven because everything's being normalized, right? We're recalibrating back to where we used to be before the pandemic. So freight is declining. So what we're seeing is what we view as kind of like the bottom of that. And, there's been a lot of destocking by retailers, and we're pretty optimistic that you're going to see some sort of seasonal uptick into the fourth quarter. We're not calling a huge peak season, but last year there was no peak. We think there's like maybe a slight speed bump of a peak this year. And what's that telling us is that the consumer is still resilient, and things should look better for UPS or FedEx into 2024 on a volume standpoint. You have that plus pricing, you have that plus productivity improvements from tech. It's hopefully going to offset some of the increase that they got in cost from that new labor agreement with the Teamsters.
So how significant was that? I mean, that was really my question. Is that a smokescreen, this whole agreement with the Teamsters to cover some real fundamental weakness that they're facing or competition? Or is this truly going to create a challenge to their profits going forward in a more material way?
It's definitely going to challenge things, but what I would say is that in the second quarter, the second quarter, that's a has-been quarter, they did a fantastic job. I mean, they beat by 4 cents in EPS, and it was all on margins. It wasn't on pricing. It wasn't on volumes. They actually disappointed. So they disappointed on the top line, and they surprised on the upside on the EPS, and that was real on margins. Their domestic business was, it was about 130 basis points better than expectations, and it was only 30 basis points less than what people were thinking.
If they can absorb it, what's the message to other logistics companies, to other trucking, shipping, flying companies that are also facing some organized complaints about the lack of wage growth, the lack of pass-through of some of their profits to the employees?
Yeah, at the end of the day, labor is increasing, and we're not going back to a 2017, 2018, 2019 level. So, if you're a truckload carrier, you had to increase what you paid your drivers. Rates have gone down considerably, and so what that's doing is forcing a lot of smaller companies out of the market, and that will firm up rates and bring rates back up. And so the Knight Swifts of the world will have much better margins in the coming quarters. So
with higher prices.
With higher prices. Right now, the truckload market is terrible. Like the spot market is pretty much bottoming. We should probably start seeing increase in spot rates into fourth quarter, and contract rates are down by low double digits. And we expect that to kind of invert positively in 2024 to see maybe mid-single digit truckload rate increases on the contractual side.
If there was high single digit, even double digit revenue growth, and that reverts back to mid-single digit, low single digit revenue growth, the slog of logistics, if you will, can they sustain a given margin down the income statement?
Really depends on what subsegment of the market you're talking about. You know, the less than truckload market where Yellow filed bankruptcy, that's a very consolidated market, so they have pricing power. FedEx, UPS, they have pricing power. Railroads, they have pricing power. Truckload carriers, not so much because it's extremely fragmented. So it really depends on what market you're in, whether or not you have the pricing power and whether or not you can push those higher costs onto your consumers.
Lee, this was great. It's good to see you. Come back soon.
I will.
Lee
Thanks.
Klasko there of Bloomberg Intelligence. Thank you very much. Just want to go back over that Fed speak from around about 5 minutes ago. This was from Patrick Harker, Philadelphia Fed president, signaling we might be at the point where we can hold rates steady and no longer increase interest rates. The Fed would need to hold rates steady for a while, he says. The U.S. economy is on a flight path towards a soft landing. We know that Mr. Kalanovic over at J.P. Morgan, based on his recent communication, disagrees with that view. But this is a couple of voting members of the FOMC, regional Fed presidents, over the last week, Goolsbee of Chicago, Harker of Philadelphia, Lisa making a point that we might be at that point where we can wait.
And they're being incredibly cautious about it, right? They are realizing that saying it's going to be a soft landing could set them up for some ridicule. I do see us on the flight path to a soft landing. This is Patrick Harker, that we all hope for, and that has proved quite elusive in the past, basically recognizing that this is a high hope. And yet, doesn't it seem like the threshold for them to hike further seems higher and higher and higher?
The difficulty they have is how do you signal that we might be done without risking a premature easing of financial conditions, Tom, which leads to a reacceleration of inflation. That's going to be the nervousness around communicating this.
That nervousness is embedded in economic academics. Austin Goolsbee's expert at this, just as, you know, with all of his work at Chicago. And the answer is pick a bank. In my case, it's Bank of Japan. I'm going to guess 18 years ago, whatever it was. They raised rates, they were wrong, oops, they had to cut rates again. That is the embedded fear of every central bank out there, which is one reason for Chairman Powell at Jackson Hole to cut it down to a 7-minute speech.
About nothing.
First do no harm is where he is right now.
We're on the same page on that, that's for sure. Mike McKee's going to drop by and get you all up to speed on the latest Fed speak and on the data as well. Coming up on the Open in the next hour, Mike Collins of PGIM, Kelsey Barrow of JP Morgan on the bond market, David Bianco of DWS Group on this equity market. With equity futures down 0.8%, the bond market rallying, yields lower by more than 10 basis points on a 10-year, and the dollar stronger. The euro 109.42 from New York. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg surveillance markets on the move. We've seen it all morning. Equities, bonds, currencies, commodities coming off the China news and disinflation, outright deflation tone across the tape. And Lisa, to be very clear here, it deteriorates into this morning, this Tuesday morning.
There's a jitteriness as people parse through what we saw out of China, this idea of a real retracement of an economy suffering from long economic COVID. And we get the trade data from the U.S. currently.
Moments ago, oil, American oil, under $80 a barrel, $79.95. With our trade balance review, Michael McKee, Bloomberg trade balance China correspondent.
This just into the Eyewitness newsroom. Trade balance for the month of June, the final number comes in at negative 65.5 trade deficit of $65.5 billion. That is down from a revised 68.3 in the month of May. It's actually good news as the trade deficit shrinks in terms of GDP growth. The exports number comes in down just a tenth and imports down 1%. Steve Stanley coming up, he can tell you what all this means for a revision to second quarter GDP, but we had seen the initial number add about 0.1% to that second quarter GDP. Interesting, we have seen in recent weeks various people, including the folks at ISM Manufacturing, the companies they surveyed, saying that both import and export orders were down. They've been down for a number of months as we, I guess, work off inventories, and so that's having an effect on the overall economy at this point.
Is global trade down on an IMF aggregate basis, OECD basis? Is global trade dampened?
It is somewhat, and we're seeing that play out in a lot of places. Obviously, China, with its data this morning, Germany is seeing its trade numbers deteriorate. So overall, the reshoring effort seems to be having, well, you got to separate that. You don't know whether it's just economic weakness or whether it's the whole reshoring thing.
How similar versus different is the story in the U.S. from China, where you saw an actual increase, as you pointed out, in exports, not necessarily that kind of retracement that you would expect based on what we saw out of China?
Well, it is interesting because the Chinese are going in a direction that we have gone for many years and now have gone the other way. Our economy is stronger, consumer demand is much stronger than in China, and at this point they're looking for ways to stimulate, and it hasn't really helped.
Michael McKee, stay with us. This is important. And this is a joy for all of Bloomberg surveillance in the umpteen years that I have been at Bloomberg, because someone we know, John, has just gotten a job promotion. He's going to become chief camp counselor here in the summer. And it is John Rogers at Goldman Sachs. He with the State Department credit, and of course, chief of staff at Goldman Sachs, and all of the Goldman Sachs philanthropy will step aside. And Michael McKee, Russell Horowitz will take over. He worked with Arthur Levitt at the Securities and Exchange Commission, worked within a Democratic administration at the White House, and he will take over. You and I know Russell well from his work at Bloomberg. news years ago.
Yeah, he worked with a lot of famous, important people, including you and I.
He was instrumental in me coming to the company. It was very kind. It's good to see Russell Horowitz will advance to that important chief of staff position at one of our venerable firms. We'll move on from there. Lisa, the market, I don't see much action off dated trade balance. Boy, that's going to be different on Thursday with the inflation report.
And it's going to be different potentially at 1 p.m. after we get the auctions of U.S. Treasuries. We're going to get the first of 3 sets of auctions today with $42 billion of 3-year notes being sold at 1.
It's going to be interesting. Stephen Stanley joins us right now, Santander, chief U.S. economist, to do the math. Does trade balance math that dated? Does it change? Like, are you sitting there as Mike reports that, moving numbers in your head about what the trend will be?
No, because the data is so volatile from one month to the next that it rarely gives us a clear view of the trend. I think in general, just to the discussion you guys were having before, it's worth remembering too that, and this is a global phenomenon related to COVID, that all the economies around the world are kind of shifting back towards services and away from goods. So I think that probably weighs on the trade flows as well.
We had a bond expert come in today and say nominal GDP is coming in. We're going to see real GDP challenged, and that inflation dynamic is going to come down as well. Where's nominal GDP, the animal spirit of the nation, 1 year out?
Yeah, I think it's probably going to be down quite a bit, but still significantly positive. I mean, we've been waiting for this recession that the consensus has been calling for, and it just hasn't happened. I think there's a better chance of it in 24, but I think the economy probably is able to muddle through. Nominal GDP next year probably between 3% and 4%.
One of the key questions is the muddle through economy. Does that leave inflation higher on the other end? Are you in the camp that it does?
Well, I think the Fed has the power to get inflation back to 2%. It's just a matter of whether they're going to do what they need to do, and are they prepared to take whatever pain that brings with it. So far, we've gotten a good bit of disinflation without really a lot of pain on the real economy side. And the Fed, of course, hopes that continues, but we'll have to see about that.
Well, we just heard this morning from Patrick Harker of Philadelphia saying the same kind of thing that we heard from some of his compatriots, that the soft landing is kind of elusive, but it looks kind of like we're getting close. And then all of a sudden, the Treasury supply comes into focus. How closely are you watching the Treasury auctions, not just today, the 3-year, but tomorrow, the 10-year, and the day after, 30-year, to understand what the yield dynamic will be going out?
Right. No, I think the supply thing is one of the most overrated forces on interest rates historically. Typically, people talk about, oh my gosh, we got these big budget deficits, and it almost never seems to have a real impact on yields. But this is an example where it has, and I think there's a reason for that, which is that the fiscal situation is in really bad shape. Typically, when the deficits are rising, it's because the economy's weak, and so if you just look at the correlation, high deficits are correlated with low interest rates because the economy is typically weak. What we've had over the last 5 to 10 years, if you kind of filter out for COVID, is the deficit is rising on a trend basis at a time when the economy is doing okay.
In your study of the American economy, can you comfortably aggregate statistics now, or do you have to take a more disaggregated approach? Because even if we have a slowdown of some type, there's part of America, the haves, that are doing so great, technologically advanced, blah, 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 but there's another part being left behind. Do you disaggregate, or can you sum together?
I think it's a lot easier to disaggregate now because there's so much more data, and the data is available on a more detailed basis, and it does help, I think. The current situation is actually a great example of that, where everybody, the question is always, are we in a recession? Are we going to have a recession? But then you look at different parts of the economy. Housing has been in a recession, or was in a recession in the second half of last year, and arguably has already, bottomed out. Manufacturing, I would argue, is in a recession right now. The consumer is definitely not. So when we ask, is the economy in a recession, I think it's, to your point about disaggregating, it's better to kind of look under the surface at various sectors.
So what's your real GDP, nominal GDP call out 12 months? Just quickly, what are those numbers?
So I've got real GDP running around 1%.
That low?
Middle of next year, yeah.
Okay, well, this is important. You got a 1% U.S. economy. What portion of people with a 1% economy, I believe that's not a recession, baloney. What percentage of America feels like a 1% real GDP is a recession? I would say it's substantial.
Well, it depends on how the labor market responds. And we've had slow growth for a while, and the labor market has stayed strong. I think companies are to some degree maybe hoarding labor, given how hard it was to find people during the pandemic. This is the dream of Chairman Powell and those at the Fed, that they can get growth down enough to bring inflation down without seeing a big jump in the unemployment rate. Again, so far so good, but we're certainly not out of the woods yet on that one. But really, I think when you talk about people feeling a recession, how they feel it is they lose their jobs.
We've seen one economist after another come out and say, all right, maybe we're not going to get recession this year, maybe even not next year. We're going to push that out, or maybe just take it off the table. Are you in the same camp? Is there anything that you're sort of reassessing after the slew of stronger than expected data that we've gotten so far?
Yeah, I was always more optimistic than the consensus for this year. And a big part of my thought process was that consumers were sitting on a tremendous amount of liquidity left over from the pandemic. The labor market was going to be healthy enough to support good income growth. And I think that has borne out. The question is what happens once consumers have spent down most of that cushion and the full effect of Fed hikes has passed through into the economy, which is why I'm a little more worried about 2024. I mean, my base case is that we do kind of muddle through, but I think if we're going to get a recession, I've always felt it was more likely in 2024 than this year.
You said that it is important to watch what the Fed does to make sure that they have the conviction to bring inflation back to the 2% target. Based on the rhetoric that you've heard so far, do you have that confidence?
I do. I think they definitely were late beginning the tightening, but you have to be impressed with how forceful they've been since March of last year. Whether they stop here or go another 25 or another 50 is less important than having the conviction to stay at a restrictive level until they get the job done. And I think that it seems like there's whether you're talking about hawks or doves on the committee right now, it seems like everybody's on that page.
Steve Stanley, thank you so much for the update. We look forward to stealing your literature here in the next couple of days. He's with Santander. He'll make adjustments as well. Futures negative 32. It's a little bit of a bounce off the agony of the last hour. Dow futures negative 255, above 35,000 on the Dow. The VIX out to stick, 16.90. A little bit of tensions there. 30-year bond, Lisa, we've had to medicate her to get through the morning. 11 basis points in 30-year. I can't even, I'm gasping. I loaded the boat on the 30-year yesterday. Look how that worked out.
Well, that's actually a positive. If you see the yields come in, you loaded the boat. That's actually a good thing, right? Because yields are coming in so significantly. The concern that people have at this point is how many people are going to come in. And we've heard from Rob Waldner saying he's buying. He actually sees this as a great time to lock an opportunity. We were hearing from Mira Patel of over at JP Morgan Asset Management. Yeah. Similarly, are we in the same kind of zone where suddenly people are saying lock in 4% yields over 10 years looks pretty good because we're not going back to a normal where yields and inflation is going to be materially higher.
The polarities, if you've been great about the polarities, have been just absolutely extraordinary. And the answer is if you get a Stephen Stanley nominal real GDP or an Ed Hyman nominal or real GDP, that's where Rob Waldner's saying you get a 4% 10-year and then you bring it in lower from there.
And Mira Pendit over at JP Morgan Asset Management
that's price up, yield down.
Thank you. That's very good. Excellent.
Yes. John Writing taught me that.
That's excellent.
Only one that taught me. Let me do a data check here. We need to do that within all going on in the markets. Dollar stronger and nicely stronger, I should say. Euro well under 110, a 109.47. Equity markets, Standard & Poor's down 0.7%.
Tom, you mentioned this story out of Goldman Sachs, Dealbook reporting that John Rogers, who has been chief of staff, handing his role to Russell Horowitz, a compatriot of yours and of Michael McKee's. What I think is interesting here is this comes amid the slew of departures that we keep reporting, this sort of overhaul. And in this column, it talks about how David Solomon is conducting an overhaul of the bank. And I don't know what the connection is to some of the departures, but it is interesting to see that the key strategist is also having a changing of hands.
I don't know this story on John Rogers, and maybe Sonali Basak and others, Sri Natarajan can give us some insight here, but I would say within a large firm like this, you have staff, operations, people doing speech writing, scheduling, which event. I got 5 events to go to. Which one is the one of best value to the firm? That's what John Rogers brought to the table, as well as all of the philanthropic work that Goldman Sachs does. John Rogers provided huge leadership there.
So John Rogers, according to DealBook, who is 67 years old, is not leaving the company. He is going to retain other positions at Goldman, whether it's vice president, secretary to the board, et cetera. So he still will play some roles. It's more.
He could spearhead their ownership of the New York Yankees, which is needed right now.
Is that what you're suggesting right now?
I would
Is
suggest
that
that
an
John
open
Rogers could
invitation?
take his time to do that, yes.
You think that he'd be a good leader, good manager?
Well, I think he could spearhead the effort for a busy Goldman Sachs.
Are you trying to foster the Yankees' prowess
Somebody
based
better.
on the
After
Red
the
Sox
last-
performance?
Well, the Red
Where's
Sox
your
is hopeless.
allegiance?
You know, my allegiance is, they're both in last places, my allegiance. Stay with us here. We got some real churn to the market here this morning. And again, Russell Horowitz to be the new chief of staff at Goldman Sachs after his tenure years ago at Bloomberg News. Please stay with us worldwide, Bloomberg Radio and Bloomberg Television. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I think the most important thing that happened this year in Bitcoin is Larry Fink. He got orange-pilled, as we say. Orange pill is when you take a non-believer and you make him a believer in Bitcoin. And Larry was a non-believer, and now he says, hey, this is going to be a global currency. People around the world all trust.
Novogratz. There's no other way to put it. He is Novogratz. Mike Novogratz, Galaxy Digital founder and CEO, which barely describes his interesting career across Wall Street. He is someone that's been out front on Bitcoin and continues to advocate for Bitcoin. That is part of an important conversation with David Rubenstein, Bloomberg Wealth, tonight at 9 p.m., and, of course, all of the Bloomberg Digital media. Lisa Bramwitz and Tom King, thrilled that David Rubenstein could join us this morning. This is perfectly timed because Novogratz has been the piñata of Bitcoin when it goes down. It's been the genius of Bitcoin when it goes up. And all of a sudden, Larry showed up at the door to say, hey, big, respectable firms can prosecute and do Bitcoin. Link Lawrence Fink of BlackRock to Mike Novogratz.
Well, what's happened is people, as you suggest, make fun of Bitcoin and other cryptocurrencies, but now the establishment, Larry Fink at BlackRock, is now saying they're going to have an ETF, if approved by the government, in Bitcoin. So you're saying, wait a second, if the mighty BlackRock is willing to have an ETF in Bitcoin, maybe Bitcoin's going to be around for a while.
Lisa wants to jump in here, but I'm going to cut to the news moment. Is Carlyle announcing this morning a Bitcoin advocacy?
No, I don't think so. But there's no doubt that Bitcoin is something that I wish I had bought it at $100 a Bitcoin when Mike Novogratz started buying it. It's now at $29,000. So he's made a lot of money. And a lot of people who bought it at the $100 or less are feeling pretty good. Now, it went up as high as 61,000, I think. Even down to 31,000 or even 29,000 now is still pretty good profit if you bought it at 100.
We all wish we would have bought it at 100 and to ride it up. It's one thing for BlackRock to come up with an ETF because they believe in the proposition of Bitcoin. It's another because they see a profitability proposition where they can, basically take advantage of the interests other people have. I mean, isn't that more of what this is? That basically Wall Street is saying, if there is a market for it and we can viably make one for them and make some money, why not?
Well, remember, Wall Street is in business to make money, and this is something they can probably make money of. You have to remember, the United States government has been somewhat skeptical of it. I think Democrats in the Congress, and particularly the people regulating the SEC, are skeptical of Bitcoin and other cryptocurrencies. But outside the United States, there's a lot of interest in it. I think FTX really hurt when it went bankrupt, and it hurt the crypto industry. But a lot of people around the world want to be able to trade in a currency that their government can't know what they have, and they want to be able to move it around, rightly or wrongly. And so I don't think Bitcoin is going away. And I think the Republicans on Capitol Hill have been pretty supportive of it.
There's a difference between having a seamless cross-currency payment, basically saying that instead of going to Western Union, I can go and just transfer something in Bitcoin if it has a stable enough price. That's one proposition. But the proposition of Bitcoin as a store of value that could kind of be bid up the way that gold or silver could seems to have been parked with the advent of yield suddenly that you can get for actual money. I mean, isn't that sort of the feeling that you're getting?
Well, there's no doubt that when interest rates are as high as they are, you don't need to have gold or other kinds of things to get you some solid return, because when you get 5% on treasuries, but eventually 5% will be coming down at some point. I don't think Bitcoin or cryptocurrencies that are the better ones, the better known ones, Bitcoin and so a number of others, are going to go away. There's enormous interest around the world in being able to have something you can transfer without the government knowing about it and keep it private. And, you can say people shouldn't do that, but that's not going to stop people from doing it.
Mr. Novogratz and Mr. Gensler, what did you say about the efforts of our chairman of the Securities and Exchange Commission?
Well, Gary Gensler, who's the chairman of the SEC, is not a big fan of cryptocurrency. I think that's fair to say. But he lost a major case recently in court where he was trying to argue that one of the cryptocurrencies, Ripple, was a security, and he lost that case. So I think the SEC has not been able to convince at least the government yet, or at least the courts, that cryptocurrency is such a dangerous thing. And I remember a lot of people in the government now are thinking that Gary Gensler won't be the chairman of the SEC forever.
That's where I wanted to go. I mean, these guys just wait him out, right?
I think that's a strategy. It's very popular in Washington, waiting out regulators you don't like.
That seems to be something that has worked given some of the turnover that we've seen. I want to shift gears a little bit because we've been talking all week about banks losing talent to your world, to private equity, and to the sphere of private debt and equity that has continued to take more and more market share. Have you seen that accelerate recently as people really take a look at what they can earn and the potential opportunities in your world?
There's no doubt that some of the large investment banks, like Goldman Sachs and others, but not just Goldman Sachs, have people leaving. But that's actually relatively normal. People leave all these firms all the time. After people typically retire from Goldman in their early 50s, whereas a regular kind of job, you might retire in your 60s. So I don't think it's that unusual right now. And I think Goldman's obviously got a deep bench. I think it's in pretty good shape. But there's no doubt that people think that in private equity, if you do well, you can make more money than you can in investment banking. That's generally been accepted for the last 10, 20, 30 years or so.
Do you think that that's going to get pressured at all as there is more competition and, frankly, in the higher yield environment, and if there is some sort of default cycle and a little bit of stress?
Well, remember, in private equity, it's harder to do private equity deals typically today because interest rates are higher, harder.
Talking about in particular?
Well, I don't think it's a secret that in the commercial real estate office market in major cities, New York, San Francisco, among others, people are not coming into offices, and therefore employers are thinking, I don't need as much office space as I once thought I did. And also, because interest rates are higher, the value of buildings goes down. There's an inverse relationship. So if interest rates are high and the value of real estate goes down and people don't need as much real estate as they did before, and then they renew their leases, they're going to take less space, it's probably going to mean the value of these buildings is going to come down.
How concerned are you about New York City?
Well, people have been concerned about New York City for the last 200 years or so. For 200 years, people always saying New York City is going to fall apart, and for 200 years it survived. So I got a lot of things I'm worried about, but New York City is not number one.
David, thank you so much. David Rubenstein with us here. Really interesting conversation and timely conversation with Michael Novogratz. Look for that on Bloomberg Wealth tonight at 9 p.m. Lisa, what a day. I guess we got some stability in the tape with the futures at -30, down 0.7%. I mean, this China news began narratives that really shook up the market today.
And we are getting some Fed speak. We were talking about Patrick Harker earlier, talking about how it was likely that we could potentially see the Fed hold rates here for a longer period of time, and that maybe we're getting that soft landing. Nobody really wants to say that with any conviction. We're hearing from Tom Barkin of the Richmond Fed saying that inflation still remains too high. This is pretty much consensus, that GDP remains solid, labor market remarkably resilient, not necessarily tipping his hat that much, but people trying to read the tea leaves. How much conviction do they have to actually get inflation back down to 2%?
You know this. I'm afraid to ask, is there another Fed speaker today
Not
coming
today.
up?
Not today.
We're done with the pain here of crystal ball gazing.
It's important because there's a question about whether they're going to accept a 2.5%, 3% inflation rate. And if that is the case, that could have a material effect on where people are going to set their rates.
There's some disinversion going on. Forget about the vanilla spread 2s, 10s. The answer is 2s, 30s. We've really disinverted here. I mean, there's some real dynamics going on in the yield space.
I'm watching 1 p.m. I really think that this is going to be interesting. It'll be a complete non-story. We will not talk about it tomorrow. If it is really smooth and if you get a lot of bids in it. But we'll talk about it nonetheless because it's a 10-year auction tomorrow. To me, who's going to step in? Are there going to be enough people buying?
What's the one thing at 1:10 p.m. I should read of those nuances in auction processes?
How much the dealers took down, how much there was indirect buying, and just where the yield is before and where the yield is after, just as simple as that.
Your auction analysis with Lisa Abramowitz.
Thrilling morning television.
-31 Dow futures, -245. It's like watching varnish dry as well. Up a stick. You know where I am on this, folks, the auctions. Somehow the United States of America will get it done. 16.87. On the VIX. In oil, a nice pullback. West Texas Intermediate with a 79 print earlier, $80.38 on American oil. Brent crude under $84 a barrel as well. We're watching stronger dollar this morning. This is Bloomberg Surveillance.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. you know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Live from New York City this morning. Good morning, good morning. A bit of risk aversion out there right now. Equities down, yields lower, bonds rallying. Equities on the S&P negative by 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, the Treasury preparing to unleash a debt deluge, Moody's cutting ratings on 10 U.S. banks, and trade with China plunging more than forecast. We begin with the big issue. Here comes the debt.
There is kind of that perfect storm in the works right now. Treasury definitely surprising the market. This higher than expected amount of treasuries at auction.
Japan indicating that they're exiting yield curve control. This fiscal stimulus and how prolonged it's been, and uncertainty about the direction of interest rates.
We're going to get a CPI report.
Inflation is just one of the moving parts.
What's really going to be the bigger driver, in my opinion, is relative yields and demand.
Questions about will demand meet supply given the downgrade from Fitch.
The usual suspects will show up and they'll buy it.
I don't see the demand for treasuries changing.
We're backing up here in terms of yields because the supply is large.
There are a lot of factors that are coming together right now to push that long end of the curve higher.
Yields could actually move higher.
That steepening may continue to have some more legs from here.
Joining us now to discuss JP Morgan's Kelsey Barrow, PGIM's Mike Collins, two of the best in fixed income. Kelsey, first to you. Tons of supply through the week. 3-year today, 10-year tomorrow, 30-year on Thursday. Do you think we'll take this supply down without any problem?
Yeah, so we're going to be watching the auctions very, very carefully. I think there's a couple things to note. You know, each auction, you have to assess who are the marginal buyers going to be at that incremental auction and what's going on in the background. And right now, of course, we do have CPI on Thursday, so I think it would be a little premature for me to say that for certain the auction is going to go a certain way. But I think if you take a step back, what you've seen so far this year is that investors have been meeting the demand at the auctions. End user demand has been rising over the course of the year. So we think generally demand is going to rise to the occasion. And ultimately, the bigger driver of the market is going to be those fundamentals and that inflation report later in the week.
Michael Collins, let's go through the numbers. 42 billion, 3-year notes today. Later on tomorrow, 38 billion, 10-year notes. On Thursday, 30-year bonds, $23 billion worth. Are the buyers going to turn up, Mike?
Yeah, they're definitely eye-popping numbers, Jonathan, when you think about it, even in the context of the size of the global bond market, right? The U.S. government is constantly in the market borrowing money, and I think the demand will show up. You know, as Kelsey said, supply has historically been a lousy measure of interest rates, of the level of yields. It's really the fundamentals. It's about growth, which we know is slowing. It's about inflation, which we know is moderating. Of course, it depends on whether it settles down at 2 or 3 or 4. Our guess is 3. And it's about the path of the funds rate and the term premium. So those are the drivers. Our guess is, hey, anything in the 4s, especially out on the curve, 10 years and out, is a buy. That's what we've been advising our clients, and you've seen some resistance up at those levels.
Goldman agrees. Right now it is a buy and it's getting bought. Yields are lower by 8 basis points on a 10-year, 4%, 30s, 418. We're down 9 basis points there. Kelsey, Goldman say buy because they're not persuaded by the reasoning for the sell-off last week. Can we start there? Can you diagnose the sell-off of last week? What was that about?
Yeah, so I think there was a confluence of factors that were driving the sell-off last week. We had the debt downgrade, we had the Bank of Japan, we had the refunding announcements, but I think also a function of positioning. Some lazy longs out there that stopped themselves out, some new shorts getting added to the market. But ultimately, we would agree with Mike, we would agree with the analysis that you read earlier, that there is value in longer dated yields at this point. I think it's pretty notable that we have run up against 4% on the 10-year yield 4 times in this cycle, and at every single one of those times, we failed. We failed to trade sustainably above 4%. So we're testing that again right now. But when we look at the path, we expect that the Fed is likely done with the rate hiking cycle. We agree that growth is moderating, inflation is trending downward. And so ultimately, those are going to be the drivers of lower yields as we turn to the second half of the year.
More downgrades this morning, this time from Moody's on 10 regional banks, pointing to higher funding costs, potential regulatory capital weaknesses, and rising risk tied to commercial real estate loans. We've heard a lot about this. Moody's this morning. Sonali Basak, turning the volume up on the conversation.
Absolutely, because obviously these banks have had a lot of pressure, and what Moody's is saying broadly, we know. We know that there are commercial real estate pressures. We know that there are funding pressures. What's even more surprising, and you see it in the market now, John, is the ones that are under watch. These are larger, mid-sized banks. We are talking about U.S. Bancorp, one of the largest regionals here, facing the biggest drop in the market right now. There are idiosyncrasies in Moody's report. Remember, U.S. Bancorp bought MUFG Bank, MUFG Union Bank, and that has led to a lower level of capitalization. So that's why you're seeing that bank decline more. For BNY Mellon, State Street, Truist, the unfortunate thing about the Moody's report is they say an upgrade is unlikely for a lot of these firms. The silver lining for these banks, however, is contrary to what the market would think, is this idea that the longer-term capital requirements are actually a net positive for these banks. So even with these short-term pressures, there's an idea that this regulation that a lot of people thought would really stifle the banks are actually good for the credit ratings for these banks. Now, another thing that's a problem here, should these banks be downgraded, the counterparty risk means it's more expensive for these banks to do business. So it's kind of a vicious cycle, and this is the problem at stake. To your point, there's been 10 banks already downgraded. These are kind of in limbo here, which is why you're seeing such pain in the market. But again, a lot of these problems were broadly known. The ratings downgrade just adds another issue to the top of the pile.
Sonali, let's squeeze in one more bank, Goldman. I have no doubt you're going to be talking about this throughout the day. More exits at Goldman Sachs. Who's the latest?
John Rogers, the chief of staff here to the board, a very long-standing confidant. Remember, Goldman has recently added another addition to the board, and that is Tom Montag, the longtime Bank of America executive. There's a big change here in the composition of the board this year with John Rogers, historic figure at Goldman, stepping down, as well as Tom Montag coming on. So it's really changing the shape of Goldman in a way that most of the public doesn't even realize.
Stock is down 1%. For Goldman Sachs. Sonali, thank you. Thanks for that. Let's turn back to the downgrade from Moody's on those 10 lenders. Goldman, not one of them. Mike Collins, 3 reasons. Higher funding costs, potential regulatory capital weaknesses, rising risk tied to commercial real estate. Mike, all known knowns. We know all this. I'm just wondering how concerned you are about those 3 issues at the moment for U.S. lenders.
Yeah, I mean, as Sonali mentioned, the regulatory capital requirements, which are going to get tighter, right? Regulations on these regional banks are going to tighten. That's actually a benefit for bondholders, ultimately over the long term. We've actually liked the banks, as you know. One of our biggest overweights in our portfolios are the big money center banks, which have been heavily regulated. Now the big super regional banks are going to be a little more tightly regulated, and that actually is a tailwind for bond investors. So if these things underperform, if their credit spreads widen, we're typically stepping in and buying them.
And Mike, are you confident that the problems of March are behind us?
Yeah. I mean, we've screened, Jonathan, thousands of banks throughout the U.S., and you can pretty quickly come up with a short list of banks that have a big duration mismatch, have big exposure to commercial real estate, and have a disproportionate amount of that exposure to office, right? And a lot of the big super regionals that Moody's mentioned today in the report really aren't as susceptible to some of those big risks. So we're pretty comfortable over the long term that they'll be survivors.
Kelsey, do you share that more constructive view on a financial system?
Well, Well, certainly the issues that are being highlighted by the rating agencies are known knowns, as you described. But I think just taking a step back, where we've been skeptical in terms of market pricing this year is this idea of a soft landing. Now, a soft landing is possible, but the track record is not there. More likely than not, the Fed is going to engineer a hard landing, not a soft landing. That's what their track record shows. And I think it's interesting, look back at what financial markets and Fed officials were saying in 2000 and 2006, which were hiking cycles that ultimately ended in recession. You look back at what they were saying, they were talking about the same thing. They were talking about soft landing. I was looking at a Bloomberg article written in July of 2000. Cleared for soft landing was the title. Ultimately, just a few quarters later, we had a recession. So yes, these are known knowns, but we do think underneath the surface, there are cracks forming more broadly in the economy because of just this unprecedented amount of tightening that we've seen from the Federal Reserve and central banks around the world.
Kelsey, do me a favor, send me an email later with that article because I'd love to read it. We're reading the same thing again this morning. This time it's from Patrick Harker of the Philadelphia Fed. We may be at the point where we can hold rates steady. Mike Collins, he said this: we can hold rates steady for a while. The US economy is on a flight path to a soft landing. Mike, I know you share the more constructive view around all this, but Mike, what is a soft landing? It's so poorly defined. What is it?
You know, it's really averting a big recession, right? It's averting, a big spike in credit defaults by consumers and companies. It's avoiding, an unemployment rate going into the sixes, right? It's avoiding, earnings going down 10 or 15% across the corporate sector. I think we can avoid that, right? I'm definitely in the camp that the hard landing scenario is very low probability here, but to Kelsey's point, the Fed could screw this up, right? Our view is they're going to keep rates longer than what's priced in. So we're actually short interest rates in the very front end, thinking those like 2 and 5 years, maybe inch higher toward that 5.5% funds rate. But man, they could screw this up. If they keep that funds rate too high for too long, as inflation falls, you get this thing that people are calling passive tightening, right? Where the real rate gets higher and higher, and it does start to weigh, not only on banks, but on all kinds of borrowers. So the longer they keep that funds rate high, the better chance of that hard landing.
It's a really intuitive concept explained by President Williams in an interview with the New York Times earlier this week. It makes sense. I understand all that, Mike, but the risk they run if they signal that maybe it's time to cut interest rates, exactly for the reason that you described. You may send the wrong kind of signal and then trigger a premature easing of financial conditions, which leads to a re-acceleration in inflation all over again. Mike, how close are we to running that risk?
Yeah, that's why they're probably going to keep rates longer than what's priced in, right? Because they don't want to take the risk. They don't want to give the markets the green light to go ahead and shoot risk assets higher. They want to make sure inflation doesn't rebound, that this disinflation isn't transitory, that they don't make the same mistake on the way down. So I think they're going to err on the side of caution. They're going to err on the side of keeping rates higher, keeping policy tighter for longer. I think that's probably the right thing in the near term, but we all know, as Kelsey said, that typically ends badly. My guess would be that they keep rates in the fives for a longer period than what's priced in, and then at some point in the next 12 to 24 months, they're not cutting 50 or 100 basis points. They're cutting 200 or 300 basis points.
That's a big call. Kelsey, final word?
Well, I would just say that when we think about it right now, we think that the Fed is sufficiently restrictive. And so that risk that you were just asking Mike about in terms of are we at risk of the Fed pivoting too quickly and causing the economy to reaccelerate? The San Francisco Fed has a proxy Fed funds rate, which is essentially a measure of a policy restrictiveness that goes above and beyond what the Fed funds rate itself is telling you. Another way, essentially, of looking at real rates. And that level is at 7%. That's the highest it's been since the early 2000s. So essentially, no, we're not concerned about that. We already think policy is restrictive enough to get the output that the Fed wants, slower growth and lower inflation.
Kelsey, stick with us. Kelsey Barrow with Mike Collins. Coming up on this program, China's recovery, losing more steam.
Import is surprising, and that's really bad because I think it just reflects the domestic demand weakness and the weakness of the consumer even more. Generally, I think it's pretty negative news.
Trade data out of China coming in a lot weaker than expected. That conversation up next.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Import is surprising, and that's really bad because I think it just reflects the domestic demand weakness and the weakness of the consumer even more. Also, the manufacturing sector affects industrial production, and that obviously is impacted by both domestic demand and exports being very weak. Some of it might be producer prices and input costs coming down as well, but generally I think it's pretty negative news.
Here's the latest negative news. China's economic recovery taking another hit. The nation's trade plunged more than expected in July, with imports falling 12.4%. Exports seeing their worst decline since February of 2020. Damien Sasser, was it that bad?
Yeah, it was. No, and really for me, it's foreign companies operating in China, which comprise roughly a third of all of Chinese exports. They're down 14% versus 3% year to date for the broader, for broader exports, which just says it's foreign companies, it's the Mitsubishis, the Mazdas of the world that are scaling back their operations, and that's what's hitting the export side of the equation. On the import side, as your guests rightly point out, it's all domestic demand, which is falling off a cliff. Just today, we're seeing what used to be the largest seller of contracted property, Country Garden, potentially defaulting on another 2 bonds. So we've got property woes that are still kind of taking the market by storm, Jonathan. So look, we had some bad base effects, certainly going back a year ago when China was, or Shanghai was emerging from COVID, but the data is still pretty weak.
A different commodity story in the mix as well. The team here at Bloomberg, Damien, as you know, reporting the following, and I think it's worth highlighting. The value of crude oil imports fell more than 12% in the first 7 months of 23 from a year ago. The volume of crude oil actually jumped by around 12% in that time. Is there a commodity distortion in the numbers that we looked at this morning?
And we've been picking that up in the PPI data. We're going to get inflation data overnight, Jonathan. So we're going to have probably for the first time since the end of 2020 a decline in both CPI and PPI in China. And what does that mean? It just means that these deflationary pressures are really taking hold. It's bad for profits. It's bad for profit margins. And China, I'm talking Beijing here, Jonathan, has really not stepped up with a willingness to support, the corporates who are operating within China. I think that's a real issue there.
We talked about this morning. Now, we both know you can hardly talk about recession in a country that's set to generate 5% GDP growth. Are there elements of a so-called balance sheet recession starting to grip this economy. Do you see any of that taking place, Damien?
Absolutely, and it's really the fact that they just don't have anywhere to park their wealth. I mean, anyone there, I mean, will tell you, you know, the middle class especially, that they used to park their wealth in property. You can't do that any longer. You're not seeing the equity market pick it up. So what do you do with any excess cash on hand? You sit and you hide on it, and you basically keep it under your covers, and I think that's what we're seeing. There's just no demand for really soft goods or goods more generally speaking. Now, on the services side of the equation, you have seen tourist revenue, you have seen restaurants and motion pictures and all that stuff pick up to some extent, but it's just generally a very, very weak environment for consumption in China.
Damien, thank you, sir. On the latest in China and more broadly EM over the last few weeks, big conversation for us as they begin to cut rates in places like Brazil, Chile and elsewhere. Kelsey Barrow, Michael Collins back with us. Kelsey, your view on what's developing in China right now. We know it's been worse than expected. How bad is it?
Yeah, so our team in China has had a very prescient call, very skeptical on the reopening trade for China this year. And so far, it has been very disappointing. And I think from the perspective of a global investor, what the key takeaways are is that you cannot rely on China as an engine of growth that's going to pull up any other country or going to push inflation higher. If anything, they are exporting disinflation to the rest of the world. Now, one area, though, where this creates opportunity, a trade that we've really liked this year, EM local debt. You mentioned Chile and Brazil, two central banks that have started their rate easing cycle. You know, that's going to be easier if commodity inflation is coming off the boil. And I noticed today copper is down about 2%. So this is going to have implications for global inflationary dynamics.
Mike, do you like the same trade?
You know, unfortunately, yes. You know, I hate being in the same trade as everybody else here, Jonathan. But you know, it's this macro world we're operating in, and our view has been similar on China. This is not your father's Chinese recovery, right? Where they import commodities, they bolster all the emerging markets, and they export, you know, cheap goods to the rest of the world. That trade is over. That's what happened over the last 30 years. They're relying on a consumer that not only wants to get their money out of the country, they want to get their families out of the country, right? I mean, it is a consumer that's really stretched. So all of the stimulus we're seeing out of China is really just pushing on a string that does weigh down global growth. It does weigh down, you know, global inflation. And ultimately, these really high interest rates all around the world, including some of these developing countries, are probably going to be a lot lower in a year from now.
Mike, just how unsynchronized is the global economy at the moment?
You know, it is. I mean, the U.S., you know, you're seeing the global manufacturing recession, and you're seeing that in the Chinese numbers, right? But in the U.S., you're seeing a manufacturing, you know, renaissance to some extent. Europe is always closely linked to China. So as China weakens, Europe weakens, and you are seeing that play out. Emerging markets writ large are struggling a little bit. You're seeing the whole leisure sector, as Kelsey mentioned, kind of booming all around the world. The reopening trade, whereas you have a manufacturing recession. So it's not just country by country, it's sector by sector, which creates a lot of relative value opportunities for folks like us to rotate into the right parts of the world.
Kelsey, a word on that, please, just to finish.
So we agree, and it is always challenging to feel like you're in the consensus here, but we've seen a variety of different stories happening throughout the sector. So in terms of being a credit investor, an investment grade or high yield, it's certainly important to understand that the business cycle is not all humming at the exact same tune throughout these different sectors. You know, areas where we've seen a lot of strength that you've mentioned, leisure, hospitality, but at the same time, you know, there are areas that have been challenged for the past year or so and are really only just starting to recover.
Kelsey, wonderful to catch up. Kelsey Barrow, Michael Collins on the latest. Bank of America writing more recently about the same thing. Claudio Irigoyen writing the following. Growth revisions are starting to diverge. The US is moving higher, China lower. The Eurozone not showing signs of relevant acceleration, and going on to say, in DM, developed markets, the easing cycle is not around the corner, but some LATAM central banks have already started cutting. It's not synchronized at all. Tons of relative trade opportunities that Michael Collins was talking about, brought about by some of this regional divergence. Equities at the moment on the S&P negative by 0.7%. Coming up the morning calls and later, DWS Group's David Bianco making a case for avoiding big tech. That conversation's still ahead. Your opening bell, 7 minutes away.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
There's a little bit of risk aversion out there at the moment. The S&P 500 negative by about 0.6%. That's the price action. Let's get you some morning calls. First up, the likes of Truist upgrading DraftKings to buy, $44 price target, seeing a sustainable path to profitability after earnings. Telsey Advisory downgrading Home Depot to market perform, pointing to a challenging macro environment and weakening housing market trends. And finally, BMO cutting its price target on Beyond Meat down to $13 after earnings, expecting limited sales growth throughout the second half of the year. That stock is negative by 18% at $12.56 in the pre-market. Coming up, David Bianco of DWS Group recommending investors start diversifying away from big tech. That conversation up next. Your opening bell just around the corner.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Snapped a four-day losing streak on the S&P 500 in yesterday's session. This morning, we're losing again. We're down by 0.6% on the S&P. On the Nasdaq 100, down by about 0.7%. Pick your poison at the moment. Trade data out of China, not great. Downgraded US banks. We're going into CPI on Thursday and PPI on Friday. There's your opening bow. Switch on the board and get to the bond market. Going into that data later this week. Yields lower by 7 basis points on a 10-year, just in and around 4% throughout the whole of this morning, going into a ton of issuance through the week as well. Lots of 3-year debt coming to market later, the 10-year tomorrow, a 30-year auction taking place on Thursday. Classic risk-off, risk aversion captured by an equity market that's lower, a bond market that's rallying, and a dollar that's slightly stronger against the euro. That currency pair negative by 0.5%, the euro 109.48, and crude commodities selling off too. We're down by 1.4% to $80.80 on WTI. About 35 seconds into the session, we're negative here by 0.6% on the S&P. UPS, the stock to watch at the opening bow, the company cutting its full-year profit forecast, saying the revision was, quote, primarily to reflect the volume impact from labor negotiations and the costs associated with the tentative agreement reached with Teamsters just last month. Abby has more. Hey, Abby.
Hey, John. And this is really interesting because moments ago, this stock had actually been lower in the pre-market, down by about 3%. But it seems that investors are recognizing the fact that this isn't the biggest surprise. The argument, the dispute with the Teamsters was highly publicized. The tentative deal that they have in place, it would make sense that it would cost money. So in some ways, they've thrown in the kitchen sink. They are blaming not just revenue, but also rising costs on the deal. So relative to cost rising, they're saying operating margins coming in by 100 bips, 11.8% from 12.8%. For revenue, they're taking in the full year forecast down by 4% to $93 billion from $97 billion. They are citing the volume impact from labor negotiations. You also have to wonder, though, this offers a nice cover for the post-pandemic trends that we've seen out of consumers shipping less, buying less off of the internet, perhaps with inflation, buying less overall to some degree. So whether it is the labor disputes or the consumer definitely taking it in, but now the stock is down slightly, so investors still trying to figure out what this means. Package volume did slide in the quarter that was underperforming on the year to the S&P 500, John, up just slightly on the year. The S&P 500, of course, up about 17%. Company still has their work cut out for it. The stock has been stuck in a range between about 160 and 200 for more than a year.
Stock is all over the place this morning. Abby, thanks for that. About 2 minutes into the session, we're negative here by 0.9%. Tons of confusion. The South Side trying to find some clarity. This is from JP Morgan reiterating its neutral rating on the stock after earnings, writing this. Expectations were increasingly negative coming into the event, but it appears the Teamsters negotiation was more disruptive than expected, given the implied impact on volume and operating costs. We expect the stock to underperform after the longer-weighted guidance update. That stock is negative now by a little more than 1%. I want to turn to the financials. Moody's downgrading 10 U.S. small and mid-sized banks, higher funding costs, potential regulatory capital weakness, and exposure to commercial real estate, all cited with Moody's saying collectively these three developments have lowered the credit profile of a number of U.S. banks, though not all banks equally. And Shonali, there might be more to come.
There might be more to come because we know that there are almost a dozen banks also placed on ratings watch. And those are the ones to watch because they are facing a lot of pressure because of that uncertainty. They say not all banks are created equal, and they all have their own reasons for why they're facing such pressure. Northern Trust, for example, the relative weaknesses to Bank of America and JP Morgan for its funding profile, or U.S. Bancorp because of its most recent acquisition and capital levels. What does that mean for future bank acquisitions and capital levels as people try to merge, get bigger and safer in the middle of the storm? M&T Bank also one of the ones facing one of the biggest kind of drawdowns today because you do see it as one of the largest mid-sized and regional banks here with more than $200 billion in assets. Currently, John, that is right under the threshold, about $50 billion under the threshold for the U.S. stress tests. But we know that these banks will face larger capital rules ahead. So even with Moody's saying that in the long term, these capital rules could be a good thing, in the short term, we don't know how long that overhang will be. And it's another blow to the KBW Bank Index, which has been down already 13% through yesterday. Some of these banks were just flipping to the positive and today face another day of declines.
There was some hope this rally would broaden out and reach the financials in a more sustainable, durable way. Shonali, thank you. The update there, said this a few times this morning already. Rather like last week with Fitch and the Treasury, there are issues we already know about, and the downgrade just turned the volume up on the existing conversation on days like today, and we talk about it a little bit more. About 4 or 5 minutes into the session, we are negative here by 0.6%. I want to turn to media. Paramount's second quarter revenue beating analyst expectations, driven by a lift in its streaming business, while at Fox, fourth quarter revenue fell in line with expectations. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, what stood out for you?
Yes, I think the consistent theme, John, across the media earnings is we're having much better free cash flow numbers across the board. And I think part of that is, of course, it's being helped by lower content costs because of the strikes. But the other thing I think for Paramount especially was their pricing power in the digital product. We saw 47% streaming subscriber growth, and they pointed to 20% ARPU growth for next year. So good pricing power for Paramount as far as streaming is concerned. And you come to Fox, and again, you see good pricing power in the TV product just because of their heavy exposure to news and to sports. So even though we're seeing some pressures in the linear TV advertising business, we're actually seeing both of them post strong digital ad numbers. And so that's helping them recoup some of the losses on the linear TV side. So, you know, there is some bad news, but there's also plenty to cheer about at this point, at least for media.
Fox is up by almost 5%, Paramount up by close to 1 percentage point. Geetha, before you go, Disney, after the close tomorrow, Reuters out with some reporting saying that Disney is creating a task force to explore AI and cutting costs. Can you run me through what they might be thinking about?
Yeah, they're really looking here to cut down on their content costs. So remember, John, content costs for Disney is the highest in the industry, about $32 billion. And of course, a lot of that is sports, and there's not a whole lot that they can do there. But when it comes to entertainment programming, yes, you can use AI to kind of trim down those production budgets pretty substantially. And I think that's really what they're looking to do here.
How do you think people striking over in Hollywood are going to feel about that, Geetha?
Yeah, it's not going to go down well.
Not at all. Geetha, thank you. Geetha Raghunathan there of Bloomberg Intelligence. Beating a raise for Eli Lilly. Let's talk about that. The pharmaceutical raising its full-year outlook after its diabetic drug hit nearly $1 billion in sales in the quarter, comfortably topping expectations. Simone Foxman has more. Hey, Simone.
Yeah, and we're seeing the reaction in shares there up 13.5%. Two major drivers for this stock today. First, a crucial study on GLP-1 drugs from Novo Nordisk. Their drug Wegovy, which is specifically designed for weight loss, reducing the risk of heart attacks and strokes by 20%. So it's not just for diabetes anymore. This is the first study linking weight loss and the reduced risk of heart disease. And that increases the likelihood that insurance will pay for these drugs. That's important news for Eli Lilly's drug Mounjaro. It's currently approved for type type 2 diabetes, but it's likely to be approved as a weight loss drug later this year. Those strong results for Mounjaro in terms of revenue this quarter, substantially boosting the full year forecast by $2 billion, boosted earnings per share expectations for the full year to $9.70 to $9.90, up from $8.65 to $8.85. And in fact, the only drug that underperformed on Eli Lilly's shelf was Trulicity. Another GLP-1 doesn't necessarily perform quite as well as Mounjaro.
Simone, that stock is doing nicely this morning. Simone Foxman there on Eli Lilly. The broader market looks like this. 8 minutes into the session, not up quite as much as Eli Lilly. It's down by 0.75% on the S&P. On the Nasdaq, we're down by 0.9%. The tech story is the story of the year. Year to date, it's been absolutely phenomenal. DWS's David Bianco recommending investors look beyond tech and look elsewhere, writing this: we think it's important to consider diversifying away from the very large and concentrated growth premium at tech. We are underweight on tech and seeking less demanding growth stocks in healthcare, select industrials, and consumer staples. David Bianco, I'm pleased to say, joined us right now. David, wonderful to catch up with you. It always is. Let's start from the top.
Morning.
Earnings relative to last year, not great. Earnings relative to expectations, pretty decent. What is the more relevant benchmark for you and the team?
The absolute level of earnings, which will be $53 and maybe 75 cents for the second quarter of this year, which will be down 3 or 4% from last year. Perhaps more importantly, earnings are flat against 2 years ago. And we've had a lot of inflation over the past 2 years. So the real earnings growth is quite negative. I won't even get into it, but earnings quality is concerning as well. But for those who are talking about beating expectations, most of the expectations were beaten only because the estimates were cut at the last days before reporting. Long story short, earnings are going to be flattish, probably well into next year. And that's even assuming that we don't slip into a recession. This is a difficult environment for profits. It was a great environment for profits in late 2020, early 2021, and this is just going to be a long digestion before we see healthy earnings growth again out of the S&P.
David, I hate to pick on one single name. I'm certainly not an Apple analyst, but it is the biggest weighting on the S&P 500. That's right. And I think it serves as an example for the broader story that you and I can discuss. There's a name that is posting negative growth, is still up double digits year to date, and it's the biggest weighting on the S&P. David, what's the takeaway from a story like that one, without getting into new iPhone launches, etc.? But we're talking about multiple quarters of negative growth, trading at a 30 multiple, 30 times earnings. What's that about?
Jonathan, you make a really good point. I mean, Apple is the biggest company in the index, but it is probably representative of what's the thinking is and what I'm concerned about in the equity market. Earnings growth is flattish. Sure, there will be a return to healthy earnings growth probably next year. But in the meantime, look at the valuations with a name like the one you said being at about 30 times this year's earnings, and the broader S&P 500 being about 21 times earnings. But even if you exclude tech, energy, and financials, the S&P is still a little bit more than 20 times earnings this year. So I want to ask the question, if you're bullish now, why weren't you outrageously bullish over the past 10, 12 years? There's either something wrong with valuations and investor sentiment right now, or there's something very wrong with it over the past 10 years. Look, I think people were too bearish for a very, very long time, and they're trying to make up for that by being bullish now. But now's just not the right time for that. And it's not a Goldilocks economy. I would argue it's kind of a long trek through a dark woods for a lot of corporate America, and especially smaller companies, because the profitability growth is going to be hard to come to for another few quarters. So, look, I think it's been a giddy summer for the equity market, and it'll be back to reality in the autumn and into year end. This is why I think we're going to have a correction. I think tech deserves to be part of that correction. But my biggest concern at tech is really hardware and semiconductors, less so software. But yeah, the hardware, including the name you mentioned, and the chips war. The global chips war is real. There'll be a lot of CapEx spending there. I'm not sure this is going to work out also wonderfully for shareholders.
Let's get to services. You like select consumer industries. What we've heard so far in earnings season, and I know this is highly selective, it's cherry picking, but I'll pick two. JetBlue, Southwest, two airlines, basically flagging that domestic demand might be flagging. Now, David, I wonder whether we're learning anything about domestic pricing power in the United States of America. Is it fading in certain select industries?
It is fading. It should be fading, and yet in many cases the costs, particularly labor costs, are still high. I mean, you talked about unions, and these are hardworking people. I mean, and they work on site, not from the living rooms. So I mean, I don't begrudge their angst. Their real earnings power has been eroded by this inflation. So I think what you're going to see is that a lot of service industries are going to slow down on the volume growth, slow down on the pricing power, and yet, there'll still be some pass-through of rising costs. So, we have argued leaning towards services and away from goods manufacturing, but we're trying to get more selective in that and recognize that, well, there's probably some more upside on restaurants, quick serve, but I think many other services are fully valued. And then we're looking at things like industrials and healthcare, aerospace and defense, electrical equipment, and really all of healthcare, whether it be pharma, biotech, managed care. I think this is an area with very good growth at very undemanding valuations. So let's look at healthcare, industrials. Our top pick for the year was the communications sector. Has done very well, but outperformed by big cap tech. But I think in the back half of the year, move away from big cap tech, stick with certain communication stocks for longer, but really add to healthcare and industrials.
David, really appreciate the update.
But be underweight.
Be underweight what, David? No, go on. David, please, complete the thought.
But be underweight equities overall. I mean, I'm always trying to find the opportunity in the equity market, show what we most like and what we least prefer. But I think right now, hardcore equity investors, they've done really well. Why don't you do yourself a favor and take advantage of the opportunities in the fixed income market? So move away from equities a little bit toward fixed income. I don't think you'll regret that.
David Bianco, DWS Group. David, do appreciate your thoughts. As always, sir, let's catch up soon. 14 minutes into the session, equities negative here. Coming up, Fed officials continuing to debate. A pause.
Inflation does remain too high. There's still a plausible story out there that inflation normalizes in short order and the economy dodges additional pain.
The week ahead, CPI on Thursday, PPI on Friday. Mike McKee up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. But we do a breakthrough. We look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
inflation does remain too high. There's still a plausible story out there that inflation normalizes in short order and the economy dodges additional pain. There's a lot of talk over the last few weeks about the potential for what is often called a soft landing. Certainly last month's inflation read was a good one, and I hope it's a sign. Because, to be sure, the Fed's objective is not to cause a recession. It's to reduce inflation, in line with our mandate.
Richmond Fed President Thomas Barkin speaking earlier this morning on the heels of Philadelphia Fed President Patrick Harker saying the soft landing is quite plausible and is quite possible at this point. The Fed speak coming ahead of the main event later this week. It's US CPI on Thursday, PPI data on Friday. Let's get to the team coverage. Mike McKee alongside Bloomberg's Ira Jersey. Mike McKee, wrap it all up for us. How many voting members of that FOMC now are leaning into the idea that it's time to pause?
Well, there's about 2 in the undecided camp, and there are 2 who seem to think that we need to raise rates farther in terms of voters. Pat Harker, as you just mentioned, this morning coming out and saying again that he thinks they can pause absent any alarming new data between now and mid-September. He believes they are at the point they can be patient and hold rates steady and let monetary policy actions they've already taken do their work. And then, of course, yesterday we had John Williams, the New York Fed president, who said that based on what he's seen today, the debates about do we need to go with another rate increase or not? And then Michelle Bowman repeating yesterday afternoon that she thinks they probably need additional rate increases. So you've got those 3, and then Austin Goolsbee last week telling David Weston that he's undecided, but he thinks that they might need to pause and keep rates at a high level for a while. So nothing conclusive, but we do seem to be seeing some movement on the Fed to at least keep their options open for higher rates.
Ira, are we leaning into a pause here going into September 20th?
Yeah, I think we are certainly in September. I think November, obviously we'll get a lot more data before we get to the November meeting. Interestingly, the market is now pulling forward some hikes, some rate cuts for the first half of next year. Still pricing for a couple of cuts in the first half of next year. So this idea that the Fed could be on hold for a while, I think trying to define what a while means, whether that's 12 months or 18 months, which is not unprecedented in terms of the Fed being on hold, that could actually help the Fed's kind of goal here to get inflation down if we can price out some of those cuts, because pricing out, say, a cut next March is as good as putting in a hike in terms of financial conditions going forward.
Mike, what did Williams say about that in the New York Times? The ability to hold as inflation is falling.
Well, he echoed what Jay Powell has said and others, that as inflation falls, it pushes real rates higher. And you don't want to have a stealth tightening. So the Fed would look to cut rates, now not to 0 again, but to slowly bring them down in line with falling inflation and rising real rates. So we're going to be looking at the yield curve with a lot more interest in the coming months. Once the Fed sort of lets us know they're on hold, then it becomes, as Ira's pointing out, a question of when do they start cutting rates, and that'll depend on how fast inflation falls.
Mike McKee, Ira Jersey, to 2 of you. Thank you. On the latest on the Fed speak and the next Fed move. Still some data between now and then. CPI, of course, on Thursday. Another inflation print later on next month, I believe on the 13th. We have a payrolls print in between just to set up that debate on the FOMC. I want to talk about bank stocks briefly. The stocks are down by 3.62% if you're looking at the KBW Bank Index. Earlier on, in the last 24 hours or so, downgrades from Moody's on 10 names, potentially more to come. 3 reasons for it: higher funding costs, potential regulatory capital weakness, and rising risk tied to, guess what? We've talked about it a lot, commercial real estate. KBW Bank Index down 3.5%. Let's get you some more sector price action. Here's Abby.
And that downgrade by Moody's, John, certainly weighing on the mood music. As you know, the S&P 500 down about 1%. In fact, down 5 out of the last 6 days, down more than 2% over that time period. The worst stretch since March. So not surprisingly, we're looking at bearish sector composition. We have 5 sectors down more than 1%. Kind of a random mix, too. Materials, financials, some of the tech sectors. Healthcare up 0.8%, really being held up by Eli Lilly as some Ramon had been talking about earlier. And then if we take it over the last 5 days, well, we recently have been talking about breadth. Well, now we are looking at breadth to the downside. Real estate, materials, utilities, and tech. Those are the worst sectors over the last 5 days, John, weighing on the S&P 500.
Abby, thanks for that. The update on a sector price action, a broader index level story. We're down by 0.9% on the S&P. Near session lows on the NASDAQ, lower by more than 1 full percentage point. Up next, your trading diary.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Banks are down, tech is struggling, the Nasdaq's down by 1.2%. Apple's negative for a 6th consecutive session, down something like 10% over those 6 days, the longest daily losing streak back to January of last year. Keep an eye on that name, as I'm sure you always do. On the S&P, we're down about 0.9%. That's the price action. Here's the trading diary. Coming up, the US Treasury selling $42 billion of 3-year notes at 1 p.m. Eastern. Wednesday, 10-year notes. Thursday, $23 billion of 30-year bonds. Plus, we'll get US CPI and another round of jobless claims. Fed speak from Raphael Bostic and Patrick Harker. And rounding out the week on Friday with US PPI and the UMich Consumer Sentiment Survey. From New York, that rounds out the morning for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. Markets are lower this morning. Coming up, we're going to check in with Nancy Curtin. She's a partner and global CIO of investment advisory at Alt-I. Get her market call. We might talk a little emerging markets, maybe throw China in there, as Japan as well. Lee Klaskow, he's a transportation analyst. We're talking about Yellow Freight. That's a big trucking company that went bankrupt after 99 years. UBS put out some weaker than expected numbers, so we'll break it all down with him. And then Herman Chan's got to come in and once again answer for these regional banks. What is Moody's doing with our good friends, the regional banks? Herman Chan will tell us. He's Bloomberg Intelligence analyst. He covers all that stuff. But first, let's go to John Tucker for a Bloomberg Business Flash.
All right, Paul, risk off in the markets. The investors heading to the safety right now of U.S. Treasuries. You have the benchmark 10-year yield right now at 3.99, just below 4. It is down 9 basis points. Among the things weighing on stocks, you had that weak data out of China. That was earlier. And then, of course, the downgrade of the banks by Moody's, just to preface what Herman's going to say, looking at shares of U.S. Bancorp, just picking one of them right now, that is down about 4.6%. Binky Chadha at Deutsche Bank Securities expects a deeper market sell-off.
We are basically overdue for a 3 to 5% pullback. It would be normal. Believe it or not, we are now running in, 95th percentile plus in terms of the duration, even though it seems rather short since March, since we had a 3 to 5% pullback.
Among some of the other individual shares on the move, you have United Parcel Service lowering its full-year profit forecast. Those shares are down. And then some Fed speak. The Federal Reserve Bank of Philadelphia President Patrick Harper saying the central bank may be able to cease interest rate increases, of course, barring any big surprises in the economy. Right now, the S&P 500, 43 points lower. That's down 0.9%, 44.75 on the index. The Dow Jones Industrial Average 356 points lower, and the Nasdaq 100 right now down 200 points. That is a decline of 1.3%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Matt.
Very good, John Tucker. Thank you so much. We appreciate it. From behind the wall, we hear you. We assume all is well with you. Matt Miller and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are streaming live on YouTube. Just head over to YouTube and search Bloomberg Global News, and that'll take you right to where you need to go. Looking at this market, Matt, it just feels a little heavy here today. That Moody's downgrade of the banks took me by surprise.
It's not just the Moody's downgrade of the banks, though. Also, you had the Italians saying they're going to take windfall profits.
What are they doing over there?
I don't know.
I mean, you're closer to.
I think the idea is from the progressive side, they'd say, we'll help these banks out when they're losing too much money, so we're going to take some off the top when they make too much money. Now, that's just their argument, and I think the market has a real problem with that. So the spread from Europe to the U.S. today, and of course the Moody's downgrade doesn't help at all.
Right, very good. All right, let's kind of break it down, what's happening in this market. We'll get Bailey Lipschultz. He's in here in the Bloomberg Interactive Broker Studio. He covers all the markets. And then we requested Herman Chen. He joins us here in our Bloomberg Interactive Broker Studio as well. He covers the regional banks for Bloomberg Intelligence. Bailey, let's start with you. We got a market trading off about 1% this morning. What are you looking at on your desk?
Yeah, I know Herman's going to mention it in a bit, but financials, one of the worst performers in the S&P 500. You're looking at regional banks, whether you're looking at the KRX, that KBW regional banking index right now down 3.4%, biggest drop since late June. But looking at one of the big standouts this morning, Eli Lilly trading at a record up 16%. Paul, if I asked you whether Lilly was a top 10 company in the S&P 500, what would you say?
Yeah, and it's a $400 billion market cap company trading up double digits. You don't see that very often.
It's over $500 billion market cap. Yep. Looking at year to date,
I would not have known that. Paul knew it because probably he's already looked at the description page today.
Yes, I have.
I wouldn't have thought it's one of the top 10 in the S&P. I mean, it's up there with Apple, Microsoft, Amazon.
Right now between Berkshire Hathaway and Visa. Wow. So, and in case you were wondering, in terms of market value added, over $200 billion in the last 12 months, that's a Pfizer, that is a Netflix, that's an AMD, Nike, Wells Fargo, you name it.
All right, well, at 12:20, we're going to have Mikey Shaw from Bloomberg Intelligence. He covers the stock from Bloomberg Intelligence, so he'll join us and give us the skinny there.
And another one that's outperforming, Novo Nordisk, same thing. Eli Lilly's off of earnings that beat expectations. Novo Nordisk, their blockbuster obesity drug, showed that the drug reduced risk of heart attacks and strokes. So that's a 426.
This is just one more reason for me to get hold of this shot.
You don't need that shot.
Dude, I need to lose. I weighed myself today. I came in at 209.2 pounds.
Yeah.
And I looked, because I have all this data on my Apple Watch, right? 6 months ago, I was 193.
What happened?
I've just been eating a lot of cake and ice cream.
Well, I think
and
that's
playing
the
less
answer.
and playing less squash. But at the same time, I feel like I want to reduce my risk of heart attack and stroke and get better looking. I'm going to take the shot.
I think it's just the cake and ice cream. That's where I'd go first. Herman Chen, talk to us about what Moody's is thinking here. I kind of thought we were past this crisis / challenge period for the regional banks.
Right.
What's Moody's saying here? Is anything different?
It's nothing different than what we've written about over the past few months. It's really about the fallout from the regional banking turmoil back in March and April, and also the fact that interest rates are much higher than they were a year ago. And the banks are contending with higher funding costs, higher regulation after the bank failures of SVB and Signature and First Republic. And it's going to be a challenge for asset quality potentially going forward, with office real estate being in the news and potential defaults there. So all three things are conspiring for some of these downgrades and reviews for downgrades and negative outlooks going forward for Moody's.
Are these regional banks? I mean, U.S. Bancorp is a $60 billion company out of Minneapolis, right? Bank of New York Mellon, it's one that we talk about on an almost daily basis. State Street, the same. Truist, the same.
Right.
Are these regional banks?
Some of them I would contend are not. Banks like New York Mellon are more a custodial bank that shouldn't be affected by the office CRE exposure issues. So it seems like they're just taking a fresh look across the board. But the interest rate issue is something that will affect all of these institutions.
Hey, Bailey, I'm looking at Palantir because Dan Ives from Wedbush Securities has been talking about this thing. He initiated coverage, I guess, a week or so ago, saying for him it's his #1 AI pick, and the stock's up 160%, but it's off 7% today. What's happening there?
Yeah, it seems like this is one of the stocks, like many in the AI space, where you're priced to perfection.
Yep.
So results weren't terrible. Revenue outlook was on the lower end of estimates, so down 7%. But still, when you look at it, the year-to-date performance, it's still one of those stocks that's up, 170%.
Yep.
So even with the weakness, you're still looking at a company in the $36 billion market cap that just not impressive enough to drive shares even higher. But if you got on early, it does seem like this is one of the many companies that will likely benefit in one way, shape, or form from the AI revolution and whatever that.
But do you, when you talk to your sources, you're over there on the BN side of the building, working the phones all day long. Do you hear the term AI bubble a lot? Is this a bubble?
You hear it a lot. I don't know. You talk to six, a dozen, half one or the other. It's almost like it reminds me of Bitcoin, but with a better use case, where you have people who are so gung-ho and view this as something that will continue to provide growth, and see that a lot of kind of second derivative, third derivative beneficiaries that will actually see massive increases in margins and in growth. But then you talk to other folks who point back and say, we're driven by 7 stocks. So you look at the year-to-date performance, broadly speaking, it's still being driven by the NVIDIAs, the Metas, the Apples of the world.
We haven't even brought the superconductors into this country yet.
No, we have not. That's coming. Herman, just real quick here. You highlighted back in the several months ago when we were dealing with these regional banks, earnings risk. Are we seeing earnings come down for these companies?
Yeah, you're seeing some downward revisions, and also outlooks by the bank management teams come down in terms of higher deposit costs. So they're trying to get a better handle on how quickly and how fast deposits are repricing, and how some of their non-interest-bearing deposits are exiting and remixing into other forms of deposits like CDs. So that's ongoing.
All right.
Wait. You just came back from Berlin, one of
That's
my
right.
favorite cities in the world. I actually lived there for 6, 7, 8 years. What were you doing?
Brought the kids out to Berlin and Amsterdam to give them a tour.
It was a family trip.
Yeah.
When you said the kids, I thought you meant you were visiting young analysts.
I've got my young associate downstairs, so he did not come with me.
Yeah, you don't hear the vacation trip to Berlin very often.
It's a fantastic city to visit. Did you like it?
I did. Food was excellent, and the weather was a bit rainy, so it wasn't cooperative, but enjoyed the time, and the kids got to see the Brandon Brigade and the remnants of the wall, so it was great for them to learn about the history.
Did you do the bunker tour?
We did not do the bunker tour. We got on one of those buses that took us around central part of Berlin.
That's a nice tourist thing. I like that. Yeah, we see them around New York all the time. All right, Herman, thanks so much. Herman Chan covers all the banks for Bloomberg Intelligence. Bailey Lipschultz giving us the update on those markets. He is our markets reporter for Bloomberg News. I want to bring in Ira Jersey because he's got some explaining to do. Ira Jersey is our chief U.S. interest rate strategist for Bloomberg Intelligence. Lisa Abramowitz, who's way smarter than me, is talking to me about some auctions of some notes or bills. What's the Fed doing today?
Do we care?
Recently?
It's the Treasury, right?
Treasury, yeah, the Treasury. What are they doing?
So it's it's auctions of notes and bills.
Okay.
So with the U.S. government has a lot of money that it's trying to raise this quarter. In fact, about $200 billion more than most estimates and our estimates as well. So today starts what we call the refunding process. So once a quarter, there's new 10-year notes, 20-year bonds, and 30-year bonds that are issued. And when those new ones are issued, others mature. So that's why we call this a refunding month. And those auctions tend to kind of set the tone for the market often, especially when end user demand, so investor demand, is questionable. So right now, today we have 3-year auction today at 1 o'clock, 10-year tomorrow, 30-year on Thursday. I think today will go fine. Front end treasuries are in pretty high demand right now with yields, upwards of over 4.5%. So I think that demand today will be okay. But tomorrow and Thursday, a lot of market risk comes out. So tomorrow I think will be really telling when the new benchmark 10 years auctioned.
And so this week, $103 billion, right?
Yeah. Wow.
Yeah, between and that includes bills as well as notes and bonds. So the gross amount is pretty high, but there's also, remember, 10 years ago we were issuing a whole lot of 10-year debt, so that's coming due. 3-year debt that was issued in at the beginning of the pandemic is also coming due. So there's actually a lot of maturities as well. So the net debt being raised this week is actually less than the net debt that we had last month. So there'll be some reinvestments of maturing debt into some of these auctions.
We should clarify that, Paul.
All right.
So we have a little internal chat, and I'm like, bills, notes, and bonds. I can never remember the difference. I know it's a difference in tenure.
Okay.
But what? Bills are what? Very short, and bonds are very long?
Yeah, so T-bills are maturities of 1 year and shorter that are issued. They're also issued at what's called a discount. So they'll be issued at like $95, and then a year later they'll mature at 100 at par. So that's a 5% interest rate that you'll receive from now until then. Notes are go from 2 years out to 10 years, and then anything longer than 10 years is called a bond. Notes and bonds, they're kind of interchangeable. You're not technically wrong when you say, hey, a 10-year note. But people who say 30-year bills are coming out, that's incorrect, because T-bills in particular don't pay interest. They're issued at a discount to par and then mature at par.
Even I knew that.
Well, listen, this is the kind of thing, this is one of those things, and I think we all have something like this, that I learn every few months and forget for my entire life. Like, I can never keep it in my tiny little brain.
That's why we have people like Ira Jersey, expert in this stuff. All right, so Ira, I don't know. I'm not going to Jackson Hole. That's been made plain to me for yet another year. I'm not going.
Me neither.
What am I missing there? Aside from some good Cowboy stuff, what am I missing by not being there?
Yeah, so it's all the side conversations. So where central bankers, will wind up speaking with other central bankers, and it's the informal conversations about what people are thinking that maybe they didn't say in public, or maybe their fears and risks. That's the kind of interesting conversations that people have on the side. And also, it is pretty academic-y, right? So there are a lot of papers that are presented there, both by central bankers and by academics, and so people talk about whatever the topic of that particular symposium is. Importantly, of course, is always the Fed chair's opening remarks that kick off that particular symposium, and it has been historically an opportunity for the Fed chair to either change or update or clarify something that's going on in monetary policy, and it takes place right in between two meetings of the FOMC, right in either late July or early August, and then the September meeting. I'm not sure how relevant it's going to be going forward, because now that the chair has press conferences at every single meeting, there's always the opportunity now to kind of clarify things, at least within a 6-week window. So I'm not sure it's as relevant now as it has been in the past.
Stephen Stanley
Makes me feel better.
Stephen Stanley was on the chief economist at Santander with Tom and Co. this morning. He said that usually supply, he thinks, is one of the most overrated issues affecting yields. This time may be different. Do you agree?
Well, I think it's supply typically goes up when of treasuries anyway, when the economy's in bad shape. So there's a lot of demand for treasuries, and so you're increasing deficits to kind of handle deflation, disinflationary environment, and on top of that, you have more deficit spending. Now you have higher supply to fund deficits when the economy is pretty good and inflation's high. So I think that this, I'm not going to say this time is different, because it's true that historically speaking, supply has not been particularly impactful. Like it's barely in our models. It has a very low weighting in our predictive models for where interest rates should be. But that being said, I think when you're have higher supply than is expected and inflation is still a concern, the question is how many people want to lock up their money for 10 years or 30 years at interest rates that are lower than, say, 5-year debt, right? So when the curve's inverted, I think it's a little bit more challenging maybe to make the case that, hey, I really want to own 10-year notes at 4% versus owning 5-year notes at, where are we now? If I check my terminal, at 4.10, I guess that curve is actually flattened quite a lot, steepened quite a lot. But nonetheless, you still have this interest rate differential. Yeah, the 2-year at 4.75, right? So you can invest it, make an extra almost 100 basis points for, for shortening quite substantially. Of course, the risk is, and this is what the market's telling you, is that 2 years from now, what if short-term interest rates are at 2%? Right, then you've missed your opportunity to lock in a 4% rate. So that's the analysis that investors have to go through in determining whether or not they're going to participate in tomorrow's auction.
All right, Ira, thanks so much. Appreciate it. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, reporting from the home offices of Real, Central New Jersey, the soccer powerhouse of Central New Jersey. Appreciate that. We're going to have more coming up. This is Bloomberg. Let's get some company news right now. Elisa Mateo.
Good morning. The Securities and Exchange Commission has charged nearly a dozen Wall Street firms with record-keeping failures. Among them are Wells Fargo and BNP Paribas, who have agreed to pay millions of dollars in penalties for their employees using unofficial communications like WhatsApp to conduct business. Now, Wells Fargo units agreed to pay $125 million. BNP will pay $35 million. Now, shares of Wells Fargo down about more than 2.5%. Shares of BNP Paribas down about 3%. Meanwhile, shares of Novo Nordisk, well, they are soaring right now. They're up about 17%, and this after some promising news about its popular weight loss drug. Bloomberg's Steve Rappaport has more.
Lisa, investors were encouraged by the results of a highly anticipated study that shows Novo Nordisk's obesity drug Wegovy reduces the risk of heart attacks and strokes. The Danish drug maker says obese or overweight patients with a history of cardiovascular issues were 20% less likely to suffer a cardio event than those who took a placebo. Novo shares soared more than 16% to a record high today. The company says it plans to file for an expansion of its label in the U.S. and EU this year.
And the potential weight loss treatment Mounjaro is proving well for Eli Lilly. The company raised its 2023 outlook after the diabetes drug hit nearly $1 billion in sales in the quarter. Right now, shares of Eli Lilly are up about 16%. And Apple is setting the stage for the release of its most powerful MacBook Pro ever. The tech giant has begun testing its highest-end next-generation laptop processor. The M3 Max chip will be part of a model that's expected to debut next year. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.